Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 281st VideoCast podcast for the week ending March 6th, 2025. A lot of incredible data to cover today. Lots of value you're going to get, but as always, family first. Want to congratulate Mimi and her team from Patriot for winning the gold medal this weekend at their tournament. Absolutely incredible. And also, that's me and Mimi. It was kind of cold. And then want to congratulate Annabelle and her team at Patriot for winning the bronze medal. Pretty awesome stuff. Two of my favorite parts of the weekend. This is from Mimi on the breakaway. Here you go. Yeah! All right. I don't know who that crazy screaming guy is in the background. And here's Annabelle on the 5-meter putting it away as well. Boom. Picking corners, baby. Then I want to thank Christian Dagger and Preston Mizell for having me on Varney & Co. with the great Stu Varney. And Stu, like he always likes to, wants to know what's going to happen today, what's going to happen tomorrow. And we had that huge flush on Tuesday. And I said, we are a buyer today in the hole. And then sure enough, we got a massive rebound on Wednesday, a retest today. Fridays and Mondays have been weak all year. But I do think we're going to get that turnaround. And I do think we're going to be a lot higher 2 weeks out. So time will tell. But here it is. Let's see how it plays out. Tune in here.
Now the Nasdaq is in correction territory, and as of now, the Dow is negative for the year. Market watcher Tom Hayes joins me on the phone. Here's the negatives. We've got tariffs imposed, we've got a trade war, we've got inflation that's still not beaten, and there's other things going wrong as well. And the market's way down. Is this a buying opportunity right now, Tom?
Unquestionably, Stu, this is the buying opportunity of the first quarter. We need to step back and keep in mind that tariffs were raised almost every single year following the Spanish flu in 1918, all the way up to 1929 before Smoot-Hawley. We are nowhere near those tariff levels. That's number one. Number two, Commerce Secretary Howard Lutnick has emphasized these tariffs are fentanyl related, which means there is a way out. You stop the fentanyl, we will consider stopping the tariffs. That is a huge factor. And I'm going to go out on a limb here. I'm going to tell you, Stu, markets are going to be much higher 2 weeks from now than they are right now. I'm looking at a bunch of technical indicators, which I don't spend a lot of time on. I'm a fundamental analyst. We are close to washed out across the board. So we are going to be in the market shopping today and this afternoon, and maybe tomorrow as well, but most likely today we will be putting on materially sized positions.
All right, clean-cut decision from Tom Hayes. Thanks for joining us, Tom. We appreciate you jumping in here. Thanks very much indeed.
Thanks for having me, Stu.
Sure thing. Coming up.
And we're back. And then I had the pleasure to join my friend Lou Basanese. You know him from Varney & Co. You know him from Mornings with Maria. You know him from Cavuto. We used to do the same show. And you know him from the Big Money Show on Fox Business. He is doing his own live podcast show called The Big Skinny. And I had the privilege to join him on his first episode. It was great. You can follow him on Twitter at Lou Basanese. He was an investment banker. Now he is an executive with an oil and gas roll-up, which is pretty exciting. And then also doing his show, The Big Skinny. You could also join his email list, The Big Skinny with Lou Basanese, thebigskinny.com. And he does a lot of creative companies like disruptive technology and all kinds of small cap stuff. He had a CEO from an small electronic devices company on in A Block before my segment. So we're going to tune in here.
All right, we're back. Just like you're not supposed to have a favorite kid. My son, one of my sons is in the room. I'm not going to tell him if he's my favorite. He's my favorite right now because he's right here. I can't get in trouble for that. But just like you're not supposed to have a favorite kid, you're not supposed to have a favorite friend. And I got to be honest, our next guest has become quickly one of the favorite guys I love doing television with, spending time with, because he is just a true jack of all trades, just a true digger in finding the truth. He doesn't get misled by headlines, and has just been a very successful guy, super helpful to me. So with great pleasure, I want to introduce you to Thomas Hayes of Great Hill Capital. Tom, great. Thank you for making time, my friend.
Thanks for having me, Luke. Wouldn't be anywhere else. This is going to be looking forward to this for a while.
Yeah, no pressure, man. We're going to just rely on your stock pick. So I gave a speculative microcap. Save me later on in this discussion by giving our viewers some good conservative undervalued plays. So, hey, if you're good with it, I wanted to start with a couple of the topics I started off, just kind of pardon the interruption style. Quick hit, what do you think? Agree, disagree, and tell me why. So is this bull market cooked, or are we still cooking with gas?
We're still cooking with gas. We just need to be a little bit more selective. I think, if you look at the S&P, is actually down now 0.5% year to date. But if you start to look at international and some of the other stocks, which you referenced in the A block, tremendous outperformance.
Yeah.
Europe up 15% year to date.
Yeah, my Italian brethren are up 19% alone. So we got to give a shout out to those Italians and Jersey boys like yourself.
That's right. That's right.
So where do you like in Europe? I mean, are you looking at particular opportunities? I mean, I know you run a more concentrated portfolio, wildly successful too, by the way, folks. This is not something Tom would ever say out loud. I have no problem giving him credit. He was right about Disney. I was wrong. He's probably going to be right about other big stocks. But where are you finding value now in Europe?
Yeah, in Europe, we're a bit more selective. The big arbitrage has been in the most unpopular region in the world, which is China. And I'm going to give you a stat right now, Lou, that's going to blow your mind. If you look at the Tremendous 10, which is the Chinese internet equivalent of the US Mag 7, the spread of outperformance year to date is 45% in China internet.
So that's companies like Alibaba. What are some of the names that run down that list?
Yeah, so Alibaba's up 64% year to date. If you look at my friend Brendan Ahern's K-Web ETF, China ETF, up 25% year to date. And if you look at the Magnificent Seven in the US, it's down 7.7% year to date. You can look at the ETF MAGS will give you the year-to-date performance on the basket. So what we're seeing, Lou, is we're seeing a weakening of the U.S. dollar. We're seeing the 10-year yield, bond yields come down. This all favors international. I really love that chart you put out earlier in your show about showing that while U.S. stock exceptionalism has been the norm for the last 10, 13, 14, 15 years, it actually moves in regular cycles every 10 to 15 years. And in the second term of Reagan, for instance, international stocks dramatically outperformed the U.S. after a long period of U.S. outperformance. So we can get caught up in recency bias and say only U.S. stocks because that's what's worked the last 10 years. But if we zoom out, which is a core of our framework, we'll see that these are regular cycles. And we've been talking for the last few months, lighten up on Mag 7 and start to get some international exposure. And that's been
and I think
proven out.
It's a great point, as you said it there. I want to make sure people caught the news. Start to get some international exposure, not bail out of all your U.S. exposure, but opportunistically. I mean, this is what we talk about as a tactical allocation, right? Like you have your mix, and then as opportunities present, I mean, as you said, I mean, even the beloved apple in my eye is trading at 32 times forward earnings right now. That's rich historically. I mean, you look at Alphabet, it's probably the most affordable at 19. But what valuations are you seeing in China? I mean, is it, are we talking 10 to 12 times, 14 times earnings? Like what?
Listen, you still can't give them away. This is early days. I mean, look, and by the way, I'm not sitting here to take any victory lap because as well as anyone else, I've been in BABA. This has been a position that we've been building for 2 years, and not on purpose. Okay, I mean, we started buying in the hundreds, and when it got
honey, sorry, I bought some more Alibaba.
yeah. When it got down to 60, we backed up the truck. So yes, we have a basis of 83 across all accounts. And we're very excited about that. But this is early days. I mean, basically, price is what you pay, value is what you get. They're still trading at 12, 13 times forward earnings, and growth is reaccelerating. You talk about Apple being expensive at 30 times relative to its historic multiple had been 14 times. What is, I wouldn't say concerning, but what is different is the earnings growth is low double digits, like 12% earnings growth and paying 33. If it was growing at 20%, then 33 would be very realistic. So I think that's why these things are taking a little breather for sure.
So great overview. I mean, great specifics on Baba. I know everyone is appreciating that. You said something, back up the truck. I believe this. I want to see if you agree, because I know we agree at least strategically on this. Small caps. Is it a back up the truck moment yet in small caps?
Yes.
Or is it? Okay, yeah.
Yes.
All right.
Unequivocally, yes. And by the way, and this feeds into the Mag 7 as well. So why have we been saying for months, trim back the Mag 7, get some international exposure? You nailed it in your A block. It all comes down to earnings. Yeah. So Mag 7 earnings growth is decelerating. Was 33% last year, going to be 16% or less this year. A lot of CapEx spending, unknown return on invested capital, 12, 24,
so
36.
Right. Like you can see that even in the cloud services growth, like quarter over quarter for all the bigs, like, they're making continual investments, but the growth rate there is just is decelerating. So that's happening. Right. What's happening with what I love you, I've stolen it from you. I hope you don't mind. It's flattery, right? I mean, I'm copying you. The magnificent 493. What's going on with them?
I thought a lot more people would steal that phrase. I say it every single week. We do a lot of the same shows together. It hasn't caught on. So maybe now that you say it, you're more handsome. People will listen. That
it's
would
debatable.
be incredible.
I got a chuckle from everyone here in the studio, so they obviously don't believe that. But what's the growth rates looking for them? I mean, is it reaccelerating? Is it stable?
Yeah, exactly. So it was basically negative for a couple quarters. Then it got low single digits towards the end of last year. It's going to accelerate up to low double digits in coming quarters towards the end of the year, early next year, while the Mag 7 is decelerating. So there's huge opportunities under the surface. And small caps, depending which index you look at, Lou, Russell 2000, because they're coming off such a low base, 40% plus earnings growth. Small caps, S&P 600, 21% earnings growth. You can't give these away. They're in the gutter right now because of the tariff noise, but that's going to get resolved. Welcome to Trump 2.0, same as Trump 1.0, daily volatility, and we go up.
100%. I was on Varney on Monday, and they asked, what do you think about tariffs? I'm like, look, they're going to go into effect tomorrow on Tuesday, and I wouldn't be surprised by Friday if they're not in effect. And it took till Wednesday until they started repealing or revising some. So I think you're absolutely right. Great opportunities. I want to go, before we kind of close out here, is what's your thoughts on the Fed's next move? I think Jerome Powell is the Rodney Dangerfield of finance. He gets absolutely no respect, and rightfully so, because he's screwed the pooch on the front side of predicting inflation. But what do you think his next move is in light of all the market conditions?
Well, it's interesting. Looking at today, the odds of a June cut just went up to 85%. We talk about all these things, that none of which were on people's bingo cards at the turn of the year, whether it's international outperformance, whether it's dollar weakening, whether it's yields compressing, or whether it's the Fed now cutting, which, just a few weeks ago, everyone's saying no cuts in 2025. We're going to get 2 cuts, at least 1 to 2 cuts.
Interesting.
In 2025.
So you think 2? I've been on the record saying it's maybe 1, maybe none. That was a couple weeks ago. For me, the big sticking points were the categories of inflation that were stubbornly high. So food, shelter, and energy. Those are not things you can quickly correct. So my thesis has been that, look, we're going to get stubbornly higher inflation, stuck in the 3.5 range, and because of that, Powell's going to have to wait. But you think possibly 2 cuts, which at the end of the way, that Fed put's going to be worthwhile for stock investors. So it's a net positive for us.
Exactly. The more of a, look, last thing I just want to say, keep an eye on the 10-year JGB yields. This is the most important chart that no one else is paying attention to. Those are climbing because the Bank of Japan has to hike to quell inflation, which is growing after 20 years of printing money.
Crazy, right? Like never ever did we think we would be in this situation in Japan with them coming off of
but this is key.
Rates.
If you look at the last peak was late July, before you had that Mag 7 scare in early August. Yeah. A lot of hot money has come into the Mag 7, which is a very crowded trade. It's starting to uncrowd, but not crazily yet at this time. the more they have to hike to quell inflation, the more hot money is going to come out of Mag 7. So that's why the opportunities on Mag 493, small caps, international, etc. Doesn't mean you have to get out of these great businesses. It just means more moderation. And I think that's going to be a theme and opportunity in 2025 for sure.
Listen, man, you mentioned a bingo card. I don't know that you're old enough to be playing bingo, man. We're not there yet. Don't accelerate or race to Florida. I want to, yeah, Dodd, who you'll meet in the D block. The Dodd block is from Florida. So, man, I want to thank you. I knew it would be a great conversation. I want to, we have a little different opinion on Fed maybe this year. So we'll have to come back, revisit, see who's right, see who's wrong.
I think we're both going to be right, and it's going to be one.
That's right. Split the middle, split the baby. Hey, before we go, why don't you take last word to tell everyone how they can find you, what you do exactly, what's your bread and butter, so that they need to know about Tom Hayes.
Terrific. Well, Great Hill Capital manages money for ultra high net worth qualified clients and institutions and a lot of family offices. We run a concentrated equity strategy, a hedge fund strategy, and separately managed account format. So people can just we have a blog where we post all of our research. We have a hedge fund centric Hedge Fund Tips with Tom Hayes. It's the #1 podcast in the hedge fund category. We're more specialized in that regard. They can find everything at our blog, hedgefundtips.com, or on X at hedgefundtips. And believe it or not, we're big on TikTok. When we're not dancing, we go to official Hedge Fund Tips at TikTok.
Don't say that. My teenagers are going to
available.
While it's still available, the key. Listen, man, let me give everyone the skinny on Tom from my vantage point. I got to say, you are one of the most high integrity, high quality guys that I've come across in this business, which is hard to do in an industry that is riddled with greed and arrogance. You're super successful. No one would ever know how successful because that's just not the style guy you are. But I know you put in the work. You're prolific in content that you put out. So if people ever want to get more insights from Tom, I mean, you talk about your podcast. They're usually about 2 hours long, packed with great insights. And you've been doing it for 2+ years, 3 years now? What's the time?
5 years. We're on
5 years.
280.
280. And Tom told me when I was starting this, he's like, hey, man, I did my podcast for 2 years before I got any traction. So here's to you just for being just a stand-up quality guy, a good friend. I was glad when you said, yes, you could join me on the first show. So, man, I would not want to start it any other way. So if anyone's more interested, go find Tom on Twitter, X. I can't get over calling it, Twitter. But, yeah, check him out. And if you're looking for a new hedge fund manager to run some of your money, I could not give someone a more glowing endorsement. So, man, thank you again, and see you in the studio soon.
Very grateful, Lou, and all the feelings are reciprocated. And I want to thank you because Lou helped me out with some of the TV shows and everything else, and many things along the way. And that's what a good friendship is about. And I'll see you soon when I'm back in New York.
All right, brother. Safe travels. Be well, and let's go small caps.
Thanks, buddy.
All right, bud.
And we're back. And I want to re-emphasize something that is critically important that I covered with Lou. And that is the most important chart that no one is paying attention to. And I posted this on Twitter, so you can see it here. This is the Japanese 10-year bond yield at 152. And I found it comical all day. Every single major commentator was blaming tech being down 3% on tariffs, which has nothing to do with it whatsoever. And what we really have happening, and you're seeing it as the 10-year yield has been going down, one thing that people haven't been paying attention to is European bond yields blowing out, and more importantly, the Japanese 10-year yield, this is the key to the markets, continues to go up. And what that means is the carry trade is unwinding as the BOJ has to now raise rates to fight off inflation from 20 continuous years of printing money. The free money is drying up, and a lot of that hot free money that they were able to borrow in yen for free and buy Mag 7, the most crowded trade in the world, is now evaporating as capital has a cost. It's coming out of the overvalued pockets of the market and finding undervalued pockets of the market like China, whether it's BABA up 65% year to date, whether it's KWEB up 25%, Europe up 15%, etc. That trend will continue. That said, it would not shock me to see a bounce in the Mag 7. What we said for 2025 was that Mag 7 would underperform. US index returns would be subdued because Mag 7 is such an incredibly high weight. And for, a huge opportunity under the surface in Unmagnificent 493, but much more so in international. And I also believe on the tailwind is going to be small cap. You got to pay attention to that. But amazing. Mag 7 down 7.7%. So keep an eye. As long as those JGB yields keep going up, you're going to see continued pressure on Mag 7. I think we're due for a technical bounce here on Mag 7. They could even go as high as the top of their recent range. I wouldn't bet on it, but it wouldn't surprise me. And then we're going to get through that period of seasonality that we've discussed in many of the last podcasts, where February and the first 2 weeks of March in a post-election year is very weak, and then you get a monstrous kind of rally in late March all the way through May, June. That would not surprise me whatsoever. Earnings growth coming in at 18.2% this quarter. Keeping an eye on GDP down. GDP now is estimated to come in at negative 2.4. The other thing that few people are paying attention to is now Fed funds futures, 85% chance of a cut in June, which is why I was leaning with Lou to 1 to 2 cuts. And 10-year yield and US dollar continues to fall, which favors international. Then I had the pleasure to join Kai Hoffman on Soar Financially for his podcast a few days back, and we're going to listen in here. Every single dip in Alibaba we bought because it was the cheapest amount of value for the highest earnings growth and upside opportunity. And when it turns all at once. And, 60% in a few weeks, but it's early days for the China trade. For years, politicians have been substantiating their existence by creating more and more regulation, putting more and more governors against growth. And Trump is throwing that playbook out.
Hello and welcome to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the EdJR mining guy over on X, and of course, I'm your host of this channel, and I'm looking forward to welcoming a first-time guest to the program. It's Tom Hayes. He's the chairman of Great Hill Capital, and I'm really looking forward to discussing with him like the general market outlook and the state of the economy. I know he's strong on the AI side, and he's bringing us some ideas on where to invest over 2025. What is he looking at, and what are some of the ideas that he's following? Really looking forward to this discussion. Before I switch over to my guest, please be reminded to hit that like and subscribe button. Helps us out tremendously. We much appreciate it, and thank you for it. So, Tom, it is great to have you on the program. It's good to see you. Thank you so much for joining us.
Thanks for having me, Kai. Glad to be here.
Yeah, really looking forward to this. A bit of a different perspective on what we usually talk about. So we're really going to keep it mainstream almost. Like, let's call it mainstream. Because we were just chatting and you said, oh, you're a gold focused channel. I was like, yeah, but we're trying to widen the audience a little bit and just cover topics that I'm maybe personally not as strong in, but also interested in. Is it just the general markets? And you touched on a couple topics, emerging markets, small cap indices. Like, really looking forward to learning more about that, Tom. But before we get to that, we really got to start at a high level. I'm going to ask you, since you're a first-time guest on the program, like, what's your current assessment of the economy and the financial markets?
I think on balance, the economy is strong. Earnings are very strong. We just got through earnings season for Q4. The bulk of it is done. 16.9% earnings growth, which is phenomenal. That's the good news. The bad news is guidance has been a little weaker than expected, and S&P earnings have come down. Expectations for this year from 275 for the S&P down to like below 270. Some shops are at 268. But it's not terribly concerning because this is the part of the year that I like to refer to as sandbagger season, meaning seasonally, CEOs tend to take down guidance in the first quarter to set expectations low so they can beat for the subsequent 3 quarters. And I think that will be no different this year. It's where we are. We're in the normal late February volatility chop that we see not only most years, as February is the second worst month of the year, but we see in a pronounced way post-election years on average since 1950. The S&P's down 1.3% in February. So here we are, a handful of more days, and then we'll probably start to find a bid on some of the stocks that have been hammered.
Oh, absolutely. No, it's seasonality is a big factor. We can get to that, but I got a burning question here. Like 16.9% earnings, like growth, where does it come from?
Yeah, it's been pretty broad. The whole theme for 2025 that we've been talking about for, a number of months on our podcast and our public appearances has been the Magnificent Seven earnings that drove the bus in 2024 is decelerating dramatically in 2025. So you had Magnificent Seven grow earnings in 2024 at about 33%. And what outperformed in 2024? Magnificent Seven. It's not a mystery. The problem is, and the dichotomy in the market is this year, earnings growth for the Mag 7 are going to decelerate from 33% down to now it's about 16%, almost half. And the real problem is the multiples have not compressed commensurate with the deceleration in earnings growth. So multiples have stayed up. They're starting to come in a little bit. But, if you look at the rest of the market, their earnings growth is going to accelerate from, 3-4% last year to 13, 14, 15%, and the multiple is a lot lower, maybe 16, 17 times, 18 times versus the Mag 7 at 33 times. So I think people are figuring this out and they're reallocating, which is why the Mag 7 is down over 1.5% year to date, while the S&P is up 2 and change, and some of the laggards from last year, like materials and healthcare, are up, 5, 6, 7% year to date.
Let's break that down even more. So you're talking materials is growing. There must be some consumer confidence. And the perfect topic for today, because I wrote down consumer confidence, missed expectations.
Yeah.
How does that fit together? Like when you see materials, meanings like, okay, I can spend money on home improvement and other things. I hope I'm interpreting this right, Tom. But where's that confidence coming from that we're not seeing in the numbers?
Yeah, so the consumer confidence is largely a function of a number of things. Number one is tariff fears. People have been fed this narrative that tariffs will lead to sustainable inflation. History doesn't bear that out. It's a one-time. So let's say hypothetically all the tariffs that are promised go into place and it's 25%. It's a one-time bump. It's not 25% compounded at 3% per year. That's not the way it works. So what you find, as you saw in 2018 with washing machines, you get a short-term bump in price. You look intermediate term a year later, they're kind of flat, and then 2 years out they're actually down. So people are worried about the uncertainty of tariffs. They're worried a little bit about inflation, which, by the way, this time of year, the January reports and the February reports tend to come in a little hotter seasonally. So, the last inflation reports were a little concerning for people, but that is normal for this time of the year. And I think a lot of this will be put behind us. That said, are people reallocating to where they can get more earnings growth for a lower multiple? You bet. And we're seeing the move in particular into international stocks, which are dramatically outperforming. S&P up 2 and change. European equities up 10%. That was on no one's bingo cards coming into the year. And emerging markets and China, emerging markets up 7.5%, and China absolutely flying. China tech and that's our largest position. We've been building that. It's not like we just picked it 5 weeks and it went straight up. I mean, we've been building that position for 2 years. Every single dip in Alibaba we bought because it was the cheapest amount of value for the highest earnings growth and upside opportunity. And when it turns all at once. And, 60% in a few weeks, but it's early days for the China trade.
Very early days. It's as things seem to be calming down towards, or the aggression towards China seems to be coming down a little bit. I don't know. That's, again, my gut feeling. That's what I'm sensing, and you're sort of confirming it. I want to get to Alibaba later when we talk more tech stocks and investment ideas. I want to stay on the fundamentals for now, and I know we're going to get a lot of flack and people turning off when you said the economy is strong. Because my audience believes the economy is weak, it's weakening, and there are definitely cracks in the system visible. And it seems like there's a bit of a discrepancy. There was an article in the Wall Street Journal that I discussed with another guest the other day, where 10% of the spending, the 10% are doing most of the spending, while 90% of the spending is going down dramatically. If I find it, I'll bring it up in a second. But I'm curious, break that down. The economy is strong. What do you base that on?
So look, I mean, you had 2 recessions in 2 years. In 2020, during COVID, you had 2 negative quarters of GDP growth or lack thereof. And in 2022, they never called it a recession, but you had 2 quarters of consecutive quarters of negative GDP growth. Right now, our GDP growth, depending what trackers you look at, but let's just say Atlanta Fed GDP now is at 2.3%. Goldman's a little more bearish at 1.9%. You don't get a recession with positive GDP. Okay, so whether it comes in at 1.5 or 2.5, it's really immaterial. The key is it's growing despite the headwinds. Now, to your point, are people at the lower end of the economic spectrum struggling a little bit? Yes, we see all the data. We're not blind to the default rate going up on credit cards, a little bit on auto loans, and the like. You've had rates go up dramatically, and you've had people that weren't accustomed to being able to spend a lot of discretionary money, that were, force-fed checks from the government and got used to spending and eating out and doing all those things. So when the money dried up, they kept it going on their credit cards. So yeah, there's going to be some pain at the low end, but that's been the bell curve since day one. And not only do the top 10% make up 50% or more of the spending, they pay a ton of the taxes. So it's always been that way. It's probably going to be that way. But what I will say is that in Trump 1.0, the lower and middle class did a lot better than they did under Biden. And they were really starting in terms of employment rates among minorities, in terms of real wages increasing, in terms of all of that. That group did the best, and I think that's going to be the case in Trump 2.0. So if the cost of that is a little volatility in the U.S. indices, and for those of you who are in exclusively passive indexing in the S&P 500, you're going to feel it because the Mag 7 is 35% weight of that, and their earnings are decelerating. Their CapEx is going up. Their margins are going to start to feel that if they don't get the return, which I don't think anyone expects in the next 3 to 4 quarters to see a return on the $300 billion of AI investment. And you just have to adjust. But on balance, I think as we get through the fear of the tariffs and the reality or lack thereof of the tariffs, I think you're going to find that Doge is very efficient in cutting costs, which is deflationary. That is going to offset a lot of the fears around inflation. And the 10-year yield is telling you exactly that's going to happen, which is why you saw in the last few quarters, couple of quarters, that hedge funds were the most short the 10-year treasury than they've been since late 2018. And that was the period that preceded one of the biggest bond rallies in the shortest period of time. Yields compressed. I think we're going to see the exact same thing. The smart money commercials are long bonds, very long bonds, longest since 2018. And that's why you're seeing the 10-year get bid. Yields are starting to compress. The exact opposite of what everyone was calling for a few weeks ago when the 10-year yield was at 480 and everyone said it was going to 5, and we were out publicly and said, nope, it's going to 4. I think we're going to 4, and we may not even stop at 4. We're going to see a 3 handle, which is going to shock a lot of people, and that is going to spur a level of growth, not in Mag 7, but in things like auto industry, in things like home building, which has gotten left for dead, in things like home building suppliers, tool producers like Stanley Black & Decker, which is one of our positions, like Generac, which has 75% of the home standby generator. This is the kind of stuff that's not sexy today because everyone wants to chase what's up, the shiny objects, and they're getting their heads handed to them. But it's going to be sexy 6-9 months from now when everyone is getting excited about DeWalt construction tools. Mark my words, that will be a funny day, and maybe I'll be back to celebrate a little bit of that with you. It reminds me an awful lot of when everyone was pounding the table that China was uninvestable, and we were pounding the table to buy it, backing up the truck in the 60s when Morgan Stanley was downgrading in the hole, and maybe you saw it this week, up 100% from there. And now they're upgrading China stocks. I mean, you can't make this stuff up.
No clear direction, to be quite honest. A bit flip-flopping in the wind. I just quickly want to share that chart with you that I found. And, the U.S. consumer is really, really hurting. Just looking at cumulative excess savings, that's from the article I mentioned. And I'm not sure if you can see that, Tom, but top 10% of earners, roughly savings $1.3 trillion. The other 90% of earners only have $291 billion saved anymore. We all know that the U.S. consumer is not really a big saver. The savings rate in the U.S. is 3.8%, but we're trending towards 0 here. And the question is, when do we hit the panic button? When are we in, full-on eco trouble mode? Right now, everything seems fine. I do agree, the numbers are not lying. Yes, there's a divergence, and we're seeing trouble ahead. And everybody feels it differently a little bit, depending, as this shows, what income level you're in right now as well. The disparity is just getting bigger. The question is, when are we going to see, and I'm purposely overstating it, but when are we going to see, riots in the streets?
Yeah, never. Not anytime soon. No. I mean, the Chinese were the closest to having riots in the street, and that's why they went from, hunting down, Jack Ma to wanting to basically put him in prison 2 years ago to now inviting him to meet with Xi Jinping and shaking his hand and giving him an award at the most recent CEO conference in China. So I'd be more worried about the risk. Xi really pushed it up to the edge. He had 20% of 25-year-olds with education unemployed. That's a formula for a Tiananmen Square, and he was able to pivot just in time because you saw the protesting increasing around the country, and now he's flipped. Says, okay, the guy had a huge tolerance for pain. He's flipped the switch, and now we're back off to the races in China. So that's in the rearview mirror. Now, what you're blinded, not you, but the person who constructed this chart and article are blinded by is the fact that this is no different than any time else. What they're comparing it to is a once in 100-year aberration when the government decided to pump the economy full of $7 trillion and put it in the hands of people who historically are not savers. And they've proven to the point that they're still not savers because they spent it as fast as they could. Now that it's running out, they're going back to their normal savings level pre-pandemic, which was effectively 0. And that's the way it's always been. And it's just, it's not a commentary, good or bad. It's just the way it is. As far as whether they'll be discontent related to that, I think that you're going to see an acceleration of real wages and growth in the economy and productivity like you saw in Trump 1.0, in Trump 2.0 in coming quarters, and they will be the primary beneficiaries. So while they're not saving, I think you're going to see their wages continue to creep up. But as far as them having excess savings, the last 5 years was the exception, not the rule.
Yeah, no, absolutely, because we gave them free money.
Correct.
That, to quote somebody, somebody's probably, I think Adam Taggart mentions that a lot. The pig is through the python. I think the pig has been digested almost, and excremented. I don't know. Like, I'm just
Correct. And look, you'll have credit card defaults at that level. I mean, that's nothing new. It happens every single cycle. But if you look at high yield credit spreads, which is what I pay attention to, if you want to worry about if the world is coming to an end, worry about high yield credit spreads. And right now they're telling you all is quiet on the Western Front. It could change tomorrow, but for now, it's in good stead. And if companies can refinance their debt and they can hit the capital markets, all is well.
Talk about inflation and wage growth. I think that's an interesting combination. How worried are you about inflation in general? And wage growth is roughly at 5.7%, as we're, I checked last week. It might be different now, but roughly around 5.7%. Like, how does that fit together? Are you worried about that? Is that too much? Like, how does that fit together?
Yeah, I mean, look, Elon Musk is basically firing anyone with a pulse that's willing to leave in the public sector. I think it's probably in some sense, maybe they'll overshoot and have to rehire some people, but in some sense, it's long overdue. The issue is going to be whether or not the bulk of the people who have had jobs in the public sector will or will not be absorbed by the private sector, i.e., does their skill set translate to value add, which is required in the private sector? And the answer is we don't know yet. So I think what you're going to see is a tick up in the unemployment rate, which will be offsetting the inflationary tendencies. You're going to see deflation from the decreased government spending. You're going to see inflation from some of the other parts of the economy. Rents are still elevated. Housing is still elevated. But as Besant and Trump execute on their plan to bring the 10-year yield down, why would they focus on that versus the short end of the curve? They focus on that because all mortgages are priced off of that. All long-term loans are priced off of that. And their ability to refinance the US debt is priced off of that. And finally, the foreigners who invest in the US treasuries are looking to see some semblance of fiscal responsibility and cutting costs so that they can have confidence to hold our debt. And we are showing clear steps in that direction. We will get to hundreds of billions. I don't know whether we'll get to $1 trillion or $2 trillion for sure. I bet against it, but the key is direction and perception. And right now that's moving in the right direction. Right now that is a deflationary factor offsetting the natural inflationary factors. I think the number one thing is they're going to have to be careful because at 120% debt to GDP, we have not been at this level since post-World War II, 1948. And how did they bring debt to GDP down from 120% down to 63 by 1956? It's very simple. They ran nominal growth hot, GDP ran hot, and inflation ran above trend, call it 3 to 4.5% over that time period, above their 2% target. And I think we're going to have to run it at that level this time. And if they do too much on the government spending front, those deflationary headwinds could offset the needed inflation we need to bring debt to GDP down to a more normalized range. If you look at all the productivity factors that are coming into play, workforce productivity is increasing for a first time in a long time and is going to continue to accelerate with some of the technologies. That's going to be super positive for nominal growth. I think it was Jensen Huang out there talking about the possibility of 10% GDP growth. I mean, that's a little bit crazy town, but you'd be amazed what CEOs will say when they're selling stock at highs and trying to get people to keep the bid in. But leaving that aside, on balance, there are crosswinds, but constructive for at least the foreseeable 12 to 24 months. That doesn't preclude normal 5 to 10% corrections. We get on average 3-5% pullbacks a year, 1 10% correction every year and change, 1 20% correction every 4.1 years. So, but we did have 2 of those 20% plus corrections in 2 years. So we may have pulled forward a few years of those bear markets in 2020 and 2022. And maybe we've got some blue sky for maybe a few more years than people anticipate right now.
we definitely don't anticipate it, especially on our channel. We always look for the negatives, of course. Maybe because I'm German as well, we always look for the negatives, right? But I don't want to say we're a doom and gloom channel, but we're trying to figure out what is happening, and we all know that the debt as is not sustainable, especially interest payments. We don't need to go into that, but we're all.
I'll let you in on a little secret, Kai. Doom and gloom gets more views, so if that's the goal, I would stick with the theme.
Good point. No, absolutely. You touched on it. Like the next topics. Like I really want to talk about how can we get GDP running hot again. Like how do we get to the 10% that Jensen Huang suggested, and that you quoted him saying that is actually already an indication of where things might be heading. Is it AI? Is it new technology really pushing that? Like, it seems like the US really is betting big on AI to save itself, meaning like we'll have to get GDP up. If we can't get debt under control, we have to get GDP up to keep that ratio somewhat in check. Is AI our savior, Tom?
I think that's part of the fact. I think that's part of the formula. I think we've seen an increase in productivity, but the number one thing that people don't talk enough about, which really helped in Trump 1.0, is massive deregulation. You know, for every new regulation, I think his rule is he's got to cut 4 old regulations, and you have no idea the amount of ingenuity and productivity that can be unleashed when you just take the governor off the accelerator. And for years, politicians have been substantiating their existence by creating more and more regulation, putting more and more governors against growth, and Trump is throwing that playbook out, and he's going to unleash American ingenuity and American creativity and American productivity by just letting business run. And yeah, some will run too far and they'll have to be corrected, but he's a believer of the self-correcting mechanism of the markets, and you don't need a nanny state to tell everyone what to do in every single aspect of their business. Certainly you have to have guide rails and a core set of rules, but the acceleration of the regulation has just really hindered growth and put us at a level that we're still a small country, 330 million people, certainly the largest GDP and production, but I think we could grow a lot faster if we unleash the beast, and that's what Trump did in 1.0, and we saw the results, and I think that's what we're going to see in 2.0. It's not going to be tomorrow, but it's probably going to be in a few quarters. You're going to start to see it, and you see it in CEO confidence numbers. Their confidence levels in the future outlook, which were at very depressed levels in 2024, in terms of investing, in terms of growth, in terms of confidence. It's what banks are going to be able to do in terms of lending as they start to ease up some of the restrictions on banks again. So I think that people are really have to be careful about looking in the rear view mirror and getting caught up in recency bias, meaning thinking that what has happened in the recent past is going to persist into the future, and actually zooming out and looking a little further back and see what happened during different periods of history when a different set of conditions and a different playbook was put into play, and the periods of great growth and great economic prosperity.
No, thanks for clarifying that. Really appreciate that, like putting things into perspective here. And one thing maybe to follow up, and it's a question I've asked earlier this week on the podcast, but I personally didn't follow up on the stories, Project Stargate and the impact of DeepSeek. Like my number that I had in my head was like $500 billion to be spent on AI initiatives, being infrastructure and everything else. You mentioned 300. Like personally, I expected it to be cut lower, so like your number didn't seem too far off. But the question is like the impact of DeepSeek. And like, what do you see, like, and how should we sort of factor that into future earnings as well? Like you touched on, like earnings, revisions moving forward here.
Yeah. So the 300 billion number is just the US Mag 7 for 2025. The Stargate project, Masayoshi-san came out from SoftBank talking about 200 billion. I mean, this guy's a cowboy. He's a cat that has 9 lives. I mean, he almost blew up with WeWork and flushed a ton of investors' money with that. And yet the guy goes out and raises billions of dollars like it's no problem. And then, a week after he promises 200 billion, he reports that the company lost some, multi-billions that quarter alone. So you can't make this stuff up. But the point is the direction, okay? And the direction is going to be in investments. It's going to be in CapEx. It's going to be in data centers. DeepSeek was a game changer because what they showed is that you can get similar or better results with a lot less money. Now, the question is, how much less money? Is it 95%? Is it 50%? The point is, it's less. So it messed with all of the 25-year-old analysts' Excel spreadsheets, and it was like a mind blow. And now everyone's reconfiguring, and you're seeing Alibaba had a model, Qwen 2.5, that beat both DeepSeek and OpenAI in performance on many, the majority of metrics. And that's why you're seeing Alibaba go parabolic. So I think there's going to be a tremendous amount of competition. And the beauty of DeepSeek, which I love, is that some of their performance was garnered on inferior chips. And when I think about inferior chips, I say to myself, who is the king of inferior chips? Is Intel, okay? So if they can generate performance on inferior chips at a much lower cost, imagine the possibilities for inferior companies like Intel that are trading as if they're going out of business. But if people seem to forget that they did over $50 billion of revenue in the last 12 months. Oh, and by the way, they're the only place you can get excess capacity. The whole NVIDIA story is very, very simple. They have grown data center revenue, if you look at the last 6-8 quarters, $4 billion per quarter. That sounds pretty unbelievable, except for the fact that the base of the business has gotten much larger. So that $4 billion of revenue growth each quarter a year or two ago equaled 250% revenue growth. Today, it's less than half of that. And by the end of the year, it will be less than 50% because it's not necessarily a demand issue right now. It's more of a supply issue, and they are relying on the kindness of strangers. And what I'm trying to say is they are not the captain of their own ship. They are completely dependent on Taiwan Semiconductors' capacity to produce, and Taiwan Semiconductor is producing at or beyond capacity right now, which is why they are limited to $4 billion in growth. I think Intel is going to be a solution for that down the road. But in the meantime, if you have a company trading at 30 times sales and 44 times earnings with decelerating growth, you have to be worried about that. And with the CEO filing to sell more than $1 billion+ in the last few months, I don't watch what people say. I watch what they do. And that's why you've seen negative returns for NVIDIA since June. And most people would not guess that if you talk to the average Uber driver who's excited about NVIDIA changing the world.
I don't know much about NVIDIA personally. I don't follow their, I don't read the quarterlies or anything. It's I know what they do, obviously, and I know, but not in detail. But it's my gut feeling, I love my gut feeling, by the way. But yeah. I've been watching some YouTube channels about graphics cards. They came out with a new 50 series recently, and they're all negative. Too expensive, performance not really what they promised, MSRP is not achievable, and then tariffs on top of it as well. An extra $50 for a graphics card, which is supposed to be $579, makes a difference, right?
Yeah.
So, I'd be cautious. I don't own any NVIDIA. It's not part of the market I own or play in, but I'd be cautious, personally. At least, for the next quarter, delivery rollout doesn't seem to be great. Only influencers getting graphics cards right now. Everything's really, really interesting signs, if you follow that.
Yeah.
You touched on Taiwan. I want to take it one further. I want to take one island further east, and we need to talk Japan real quick. because that's something we briefly discussed off air, and I've been trying to fit it in. Segue really is inflation in Japan, like 4% last month, and that could really derail things for everybody. Meaning liquidity is what do you call it? Like on high alert, for lack of a better term, because the yen carry trade could get unraveled here rather quickly. Meaning, if the Japanese central bank decides to raise interest rates, the cheap money could disappear. That's been propping up the U.S. market.
Correct.
Let's talk about that a little bit. And how much of a risk do you see there?
Well, all you need to do is look at inflation numbers and look at what the Bank of Japan has been doing. Inflation has been going up, and Bank of Japan has been hiking. And they've been trying to hold back hiking as much as they can because of what happened in August, and they haven't been able to. So they're going to continue to hike. Inflation is going to continue to go up. Why? Because they've been printing money since I can remember. And I think what's going to happen is that what most people don't realize is a lot of the support behind the Magnificent Seven trade, one was attributable to earnings, which are now decelerating, and two was attributable to free money, exactly as you hit the nail on the head, Kai, in that that is now going to shrivel up because as the JGBs start to have higher and higher yields, there's a cost of holding that position. And people are going to say, well, now, when money is free, like it was in 2022, when the Fed fund rate was a lot lower, what did you see? You just saw people throwing money at venture capital. Anything that had startup, people were throwing money at in 2020, 2021, and then 2022, the chickens came home to roost. Well, it's not that much different with the carry trade free money now drying up. That carry trade money wasn't going into startups, it was going into Mag 7. And I think that's going to be in question. And certainly I'm not calling for any type of correction. Like a lot of people say, well, all the concentration, it's got to be like the tech record 2000. I don't think it's going to be that. I just think they pulled forward a lot of gains. They're making a huge amount of investment. So what has helped the gains? Well, one, they've been able to buy back unlimited amounts of stock. So if you make the pieces bigger, earnings per share goes up. But now they're taking that money and they are defensively spending in AI, where they have not yet definitively produced any type of return. There is hope that they will get a return on invested capital, several years out. It remains to be seen. But in the meantime, they're tying up $300 billion of capital that used to go towards buybacks, which increased earnings per share, is now going into data centers and the like, hoping that they get a return in 3 years. So earnings growth is decelerating. Margins are going to start to decelerate on those companies. And then the financing of that, which was the carry trade in large part, is going away. So is that where you want to be? No. And people have figured that out. The market is smart. Money goes where it's treated best. And where has money gone? It's gone to international. It's gone to China tech. It's gone to a lot of places that were not on most people's bingo cards coming into the year. And places that we have aggressively large positions.
Let's turn it around. What should be on our bingo card for the rest of 2025 here, Tom? Like, what are you looking at? You touched on a few things like emerging markets. I don't want to repeat what you just said here.
Yeah.
But what else should we be adding? What are you looking for? Like deep values? Like I wrote down a name that you mentioned somewhere else. It was PayPal. And sort of like Intel, like the vultures are circling, I think, around PayPal. So I'm curious. That's what I'm picking up. There's so much competition, Klarna and many other platforms, Venmo, and all those direct payment platforms these days. Like, why is PayPal, for example, an interesting one, and why should it be in our bingo card?
Yeah, well, the good news of PayPal is that they own Venmo, so that's good. Venmo's a verb.
I didn't know.
Number two is, we were pounding the table on that in the 60s. It shot up to 90. It's now come off to 75 or 73. Because their guidance was lower than the market wanted. But if you look back to last year, Alex Chris did the exact same thing. He sandbags, he sets expectations low, and then he destroys them on the upside. And that's exactly what he's going to do this year. On the basis of his sandbagger percentage, I mean, how much lower did he guide cash flow and earnings last year relative to what he performed? We expect that they're not going to do $7 billion of free cash flow this year. They're going to do $8 billion of free cash flow this year, and they're going to use that to buy back stock. So, they've just authorized a $15 billion buyback. It's a $75 billion market cap company. They're going to buy in 20% of the stock. So other than that, how was the play, Mrs. Lincoln? I mean, you've got so much positive stuff happening. They have their investor day today, and they're explaining Braintree. Most people don't understand, like, when they take an Uber, that is PayPal. Why? Because they own Braintree, okay, which does all the Uber processing. When they order tickets for a concert through Ticketmaster, et cetera. So, they're doing $500 billion of enterprise spend that no one knows because it's not branded checkout. Their fast lane improves conversion for small business people like yourself from, sub 50% to 80%. They have, and the other reason that the market, why it sold off after, going up 50% quickly, is that he's been firing unprofitable customers. So customers that were at margins that the company actually loses money. He said, oh, yeah, I have a unique concept. We're in business to make money. So any clients that we're losing money on, we're going to just fire. And the analysts, the 24-year-olds with their Excel spreadsheets, say growth is decelerating. Meanwhile, cash flow per share is going up. Earnings per share is going up. Margins, transaction margin is going up. And it's just the beginning. Alex Christ ran 50% of Intuit, the small business division. The stock was like a double-digit multi-bagger over his tenure, and he ran 50% of revenues. And he's going to do the exact same thing. And he's going to keep under-promising and over-delivering, and somewhere around $120, $150 per share. People are going to figure it out. And you're going to have people upgrading at the top, and it'll run, just like it overshot to the downside at $60. It's going to overshoot to the upside, probably at 175 or 200. And when everyone gets excited and they're clamoring for it, like some of the other shiny objects we've seen recently come off the boil, we'll help them out and we'll lay off our stock. But until then, it's trading at a dramatic discount to intrinsic value. It's got an incredible catalyst with Alex Christ running the ship, and we're very excited about PayPal.
To my defense, Venmo doesn't exist in Europe, at least, as far as I know. So I do apologize for being ignorant that actually PayPal owns it. I didn't know that.
Most people don't, actually. Actually, probably half the people that are negative on the stock don't know that they own Venmo. So nothing to worry about there.
Maybe they should hire a PR company. I don't know. Like, it's an interesting thought, because Braintree, another one as well. Like, I don't think people are, like, what I've been hearing about PayPal are fully aware what's going on. All they see is like people using Venmo and other platforms. Like there's other banking platforms like Revolut and all those now these days that they're competing with. And there's like, oh, PayPal is dead, right?
Yeah.
But like all my US friends give me doo-doo for like not using Venmo and not being available on Venmo to send me money when we go out or something. I was like, I don't have it.
Yeah. Well, look, what we try to do as good investors is burden ourselves with the facts. So we read the public filings, we listen to the conference calls, we study the competition, and we don't enter an investment unless we have confidence. If we had to put in 100% of our net worth to own the company as equity, and JP Morgan was going to finance the debt for us to take over the entire company, would we do the deal? And, a company trading at 30 times sales and 44 times earnings, I'm probably not going to put up 100% of my net worth to own the company, because if I'm wrong, JP Morgan gets the company and I get zero. But a company like PayPal, where it's generating, $8 billion of free cash, I'd do that every single day of the week. I'd put 100. So, hey, JP Morgan, if you're listening, you want to finance the debt, I'll put up 100% of my net worth and have some meaningful equity in it. Let's do the deal.
Absolutely. No, it makes a lot of sense. And you just really made the point of this channel as well. Educate yourself and you'll be ahead of everybody else. Absolutely.
That's right.
Right. Tom, last question. And again, this is not like financial advice or anything, but I'm going to ask you like the $1 million question is if you were to invest $1 million today, how would you invest that money?
It's a good question. I mean, a couple months ago it was easy. I'd put it all in Alibaba. That's been a home run. That's our largest position. And we're not geniuses. We built it for 2 years when no one wanted it. Every time it dipped, we were buyers, and why would we have that confidence when everyone else was saying it's uninvestable and Chinese communists and all that stuff, is because it's the same leader running the country when the stock was at $320. The only difference is I could buy it in 2024 at 2014 prices, and the revenues are up 10x. The earnings per share are up 5 or 6x. Cash flow per share was up 5 or 6x. So there's not a whole lot to think about there. Leader in AI, leader in cloud, top retailer to the middle class and upper class as the economy recovers. And the government flipped the switch a year and a half ago, started doing stimulus in dribs and drabs, and now it's building up. The beach ball has been held underwater, and now it's exploding upwards. So any dips to buy in a company like Alibaba, which is our largest position, is interesting. I would also be interested in basic simple companies like Crown Castle. They own 40,000 cell towers. It generates cash. They're selling off their fiber business, generating $8 billion of cash. They're going to pay down debt. It yields 7% while you wait. That'll probably be up 50% over the next, year and a half to 2 years. Boring companies like Baxter International. They do medical devices, IV solutions, infusion pumps, et cetera. They just sold off their kidney care business to Carlyle for $3.4 billion. They're paying down debt. They're going to have a new CEO announced soon. And the reason that's so important is because the kidney care business was the slowest growth division in the company, which meant it lowered earnings growth rate, which lowered the multiple to low double digits. And I think as people start to see in coming quarters what the business looks like and the growth rate looks like, without the kidney business and with lower interest expense, more free cash flow, that multiple is going to re-rate to 18 or 20 times, even if the growth is, mid-single digits, and that stock could be, up from 35 to 60 or so. Again, this is opinion, not advice, but these are the things we own and we share, and we deal exclusively with family offices and ultra high net worth individuals. So they're sophisticated investors and they understand what we're doing. But these are opportunities for newer investors or people who aren't institutional investors to start to research the companies and see whether or not it makes sense, and talk with their financial advisors and see whether buying more growth for less dollars is a good strategy. And we have found over many years that it's an incredible strategy if done right.
No, absolutely. And, there's so many single stocks that you could pick from. Once you educate yourself on them, you're way ahead of everybody else. That's one of the reasons I like the mining game, because that's where I feel I have a leg up on others, right? And it's the exact same principle. No, Tom, really appreciate the conversation. Really enjoyed our interview here. Like, where can we send our audience? Where can we find more of your work?
Yeah, I think two things. We have a niche podcast. It's number one in the hedge fund category on FeedSpot. It's called Hedge Fund Tips with Tom Hayes. You can find it on YouTube or anywhere you get your podcast. And then on X, it's the handle is at Hedge Fund Tips. On TikTok, we have a huge audience at Official Hedge Fund Tips, and on Instagram also at Official Hedge Fund Tips. And then our website is hedgefundtips.com. We have a contact form for anyone who wants to reach out.
Fantastic. Tom, really enjoyed the conversation. Thanks for coming on Soar Financially. Much appreciated. We'll have to catch up soon, see how the things play out, and whether you've ticked a lot more on the bingo card mid-year. So we'll see if you get to scream bingo mid-year here. So perfect. Tom, thank you so much. And everybody else, thank you so much for tuning in here to Soar Financially. Tremendously appreciate the support here. Thanks for hitting the like and subscribe button. It means a lot to us. Leave a comment, leave a like down below. How are you positioned in the markets? What are you looking at these days? How nervous or impacted are you by the tariffs? Something I haven't heard from my audience before, so please put that down below as well. I talked about graphics cards and $50 being added there as well. Is that something you see on other products? Put that down below. I do want to hear from you. Thank you so much for tuning in. We'll be back with lots more. Thank you.
And we're back. So that's the broad overview. Also want to thank Fahid Salim for including me in his article on Yahoo Finance about Alibaba. You definitely want to read that one when you have a chance on hedgefundtips.com. And as a theme for what we're going to be discussing today, I want you to hear a couple quick minutes from legend Peter Lynch. Here we go.
But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. If you understand the company, you look at the balance sheet and they're doing fine, and you're hoping to get to 22 with it, 14 to 22 is terrific, 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be very, people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own. So I think that's the key to element. Another key element is that you have plenty of time. People are in an unbelievable rush to buy a stock. I'll give you an example of a well-known company. Walmart went public in October of 1970. 1970 went public. Already had a great record. It had 15 years performance, great balance sheet. You could have waited 10 years saying you're a very conservative investor. You're not sure this Walmart can make it. You want to check. You see them operate in small towns. You're afraid they can only make it in 7 or 8 states. You want to wait till they go to more states. You keep waiting. You could have bought Walmart 10 years after they went public and made 35 times your money. If you bought it when they went public, you would have made 500 times your money. But you could have waited 10 years after Walmart went public and made over 30 times your money.
And we're back. And our quotes of the week. Some entrepreneurs think, how can I make a lot of money? But the better way is to think, how can I make people's lives a lot better? If you get it right, the money will come. That's from Richard Branson. And I like to say, if you help enough other people get what they want, you will get what you want. And for so many people, they get it backwards. And that's why they never get what they want. Opportunities come in frequently. When it rains gold, put out the bucket, not the thimble. That's from Warren Buffett. This week created some of those opportunities. I'm sure several of you that have been longtime listeners were definitely plugging into that to take advantage. And then Jim Rohn, time is more valuable than money. You can get more money, but you can't get more time. And I know that's why so many of you uber successful people in the world tune into Hedge Fund Tips with Tom Hayes each week to basically in 1 hour, if you include the Ask Me Anything questions, 2 hours, get what takes us, 80 some odd man hours to accumulate over the previous 7 days from, just a small percentage of the research that we do that goes into the portfolios, etc. And finally, I really want to thank the folks over at FeedSpot for selecting Hedge Fund Tips with Tom Hayes as the #1 hedge fund podcast. You can go ahead and check out the link here with the list for all the others, but very, very grateful for that and grateful for you making it that, because if not for you, then it wouldn't happen. So I'm going to encourage you, if you're watching this on YouTube, which we always encourage because of all the data charts we go through, and if you can't visually see it, it's still better than not listening, but there's such an enormous advantage to watching. And when it comes down to getting more value per your minute, you can always get more money, you can't get more time. Viewing it, you'll get 10 times the value as listening to it. And I would encourage you to like the video and subscribe to the channel at Hedge Fund Tips. And all you do is just go to YouTube and then type in Hedge Fund Tips. If it doesn't come up for you already. And then all you need to do is click subscribe And then I'm also going to encourage you, beyond subscribing, like it, subscribe to the channel, and then comment below. The more people that do that, the longer we're going to be doing this for you free of charge. Thanks to my incredible clients who indirectly underwrite this for everyone's benefit. But the more you guys get the algos going with comments and likes and subscribes and all of that stuff, and recommending to your friends and family that are interested in the markets, the more that it's going to go viral and be an incredible resource for you for many years to come. Want to thank my buddy over at RBC for putting out the Slumer stuff. You can see here, market taking a little bit of a breather. I think we're getting close to that bounce, and here's what he's looking at. Basically in the first year, you get into that 10, 11, 12 weeks. We should be getting a bounce here, retest. We're kind of in this zone here before we get a monster rally going into effectively the summer before peaking out. That's kind of the model. Next year will be a little more rocky depending on where you are in the market, but I think we're going to make a lot of hay while the sun shines here, and I'm very, very excited and took advantage, as we said this week with Varney, and I think in coming weeks we're going to be a lot higher than we were on the day of that interview. So you can see here on the daily, kind of getting oversold here. 10-year yield completely rolled over. We'll get a little bit of a bounce here, I'm sure, oversold bounce, just like I think we'll get an oversold bounce in Mag 7. So, NVIDIA down almost a third now since we published that article in June. And we'll get a 10-point bounce, and people will say, oh, this is great, blah, blah, blah. But for all the reasons we've covered in previous podcasts, I think these things are going to be in a range, consolidating a lot of gains for a long period of time, and there's going to be a ton of money made elsewhere. On to the charts of the week. So want to cover these. This I thought was interesting, the commodities to equities ratio versus the US dollar. And you can see here the different trade weighted index and how commodities are at a bottom, like we saw in 2000, 2001, and prior to that in Reagan's second term, before commodities turned up and some of the overvalued pockets normalized. This is the key to the market, the 10-year bond yield. That's the chart that you should be looking at every day, not Donald Trump's tweets about this tariff or that tariff. That's just a sideshow that's got everyone distracted from the real focus at heart here, which is the carry trade unwind. And if it relates to owning tech, are tariffs important? Yes. But you have to keep in mind, these are not 25% compounded at 10% a year. This is a one-off, level up, not compounded every year. So it's just going to be a tax on the poor. That's effectively what it is if it goes through. And I would not make that bet. I think what you're going to find is some compromise and somewhere in the middle, and the market will be relieved and it will move forward just like it does. That's why you see in the first year after the election, that January through March, early March period gets extremely volatile, because the market likes certainty. They don't care if the policy is good or bad. They just care that they know what it is, so they know what the rules of the game are. And once Wall Street knows the rules of the game, then they get on with making money, because that's what Wall Street does. This is a chart from Lou Basanese via Charlie Bilello. And we've covered this many times, but it's critically important to understand, because people are so stooped in recency bias from the zero interest rate policy period that favored Mag 7 and stocks trading at 10 times sales and all the things that were frothy. And you can see, going back 40, 50 some odd years, every 10 years, it just switches back and forward from U.S. outperformance to international outperformance, from U.S. performance to international outperformance, which you saw in the second term of Reagan, US outperformance, international outperformance, etc. And this time will be no different. We have started a period here in recent months of US outperformance. And if this was updated, we'd probably start to see the red with international dramatic outperformance. As a matter of fact, the spread between Mag 7 and the tremendous 10 top internet giants is 42% of outperformance year to date, with Mag 7 down 7.7 and the tremendous 10 up some 35%. Here's Matt Sermonaro. Oversold. VIX 1 month minus VIX 3 months is usually where you get a bounce. We agree. We're going to show you a bunch of things that point to a bounce in coming weeks, and I do think we're going to wind up higher a couple weeks out than we are now, and maybe a lot higher. This shows some of the stuffing taken out in the last few days. Year to date, Amazon down probably at this point down 19-20%. Microsoft probably 20%, Google over 20%, Nvidia closer to 30% maybe now. Bitcoin probably 30%. Palantir I think was down another 10% today, so probably 40%, maybe 45%. Coinbase, that's probably down 50%. This was at the end of last week that he put out these numbers. Tesla's probably 50%, etc. So Fartcoin, shockingly, down 89%. It may be down 95% now. And that's how it goes. Here's again, just a reminder, when you guys feel bumps in the road the next couple of weeks, just know that this is exactly the playbook for post-election cycle years. And then get ready, buckle up. We're going straight up through the summer. And no one's going to know what hit them. And whether you look at this one or you look at Ned Davis Research, this is just a composite going all the way back. In this case, where does he start this data? I know most of them are going back to 1955. Here's home builders. We want to be looking for buyers as rates come down. The big play that everyone's going to be surprised about is I think home builders will come back, but I'd rather play it through the leverage on the leverage, which is the Stanley Black & Deckers, the Generacs of the world, the suppliers that are going to be monsters as rates go down. And same thing with cars. I don't want the builders of the homes. I want the ones that supply the builders of the homes. I don't want the automakers. I want the suppliers of the automakers like Cooper Standard. And we're going to cover some really interesting things that President Trump said in his address to Congress this week about car loans. So we'll just keep that cliffhanger going. And you can see Microsoft's valuation tracking the 10-year real bond yield inversely. This is just another way of saying that as yields go up, the multiple on Microsoft Japanese bond yields go up, the multiple paid on Microsoft goes down. And they're talking about tariffs to explain why US-based tech companies are down, which makes zero sense. But that's why you tune in here, to get the scoop and to set yourself up for success. Dividend players jump to a 2.5-month high versus non-payers. We love the dividend payers, and all the type of stocks we've talked about are going to benefit from that, and many whether it's healthcare with the Baxters, whether it's the Stanley Black & Decker, dividend aristocrat type stocks, you want to have exposure. Margin debt rises to 2021 levels. Well, on the one hand, that implies that you get a tech wreck like you had in 2022. We've already kind of had it 20%. Maybe we'll have a little bit more in those overvalued pockets, but I do think they're getting close to a technical bounce area, and I do think that they will trade in a range for some time, bouncing around while other things outperform. But what this doesn't account for is the fact that the value of the market is much higher than it was. So the the margin debt as a percentage is still lower, but I get the point they're trying to make. It's just not scaled correctly. Southbound February, buying the most since early 2021. So that was a very positive period for Chinese stocks. Average price move in the, so you can see here on average, Mondays and Fridays have been the weakest since for 2025, and then going all the way back to 1928, Mondays have always been the weakest, with Fridays coming in a close second. So my guess is we probably do turn around Tuesday. However, we do have the jobs report tomorrow. That could be a catalyst. If it comes in weak from all the layoffs in Washington, then maybe you could see expectations for a Fed cut coming in earlier than June. And if it's really bad, this month is on the table for the Fed. Not probabilistic, but from a non-possibility to a possibility, that's going to impact interest rates, which is going to impact car loans, which is going to impact mortgages, which is going to impact the ability for the U.S. to refinance boatloads of debt at lower rates. Some of this chaos may be less by accident and more by design than originally thought. So, what are we keeping our eyes on? Japanese government bond yields, followed by European bond yields. Pay close attention, because if those blow out, number one, you're going to have the ECB cutting. Okay, so that's stimulative already. Number two, you have uncertainty like 2011, because they have high debt to GDP and they still structurally set up in a very fragile way, the way that they are unable to issue bonds in the same way that the U.S. can, creates complications. So we saw that in 2011. If fear about that shows up, then there will be a further and stronger bid into U.S. Treasuries. And that's potentially where we get the 3 handle on the 10-year, which, again, no one's bingo card except the incredible, amazing listeners of Hedge Fund Tips with Tom Hayes. So you see this stuff. Lots of bears for stocks near new highs. Okay. This is market concentration as it's ever been. Share of the top 5 companies by market cap in the S&P 500. So look, these are historically unsustainable. And all that means is it's going to be a rotation out of what's concentrated and into what's unconcentrated. And that doesn't necessarily imply a crash of the indices. It can be a rotation with those stalling out and others picking up as their earnings growth accelerates and as the concentrated numbers decelerate. So theme over and over, now playing out in real time. Most of the world is surprised, and no one here is, which is how we like it. Higher January and lower February is common. Now what? A year later, 12.3%. Okay, that's from Carson. Initial jobless claims in Washington, D.C. skyrocket. That's why if this jobs report comes in weak, it's going to be very constructive from a market standpoint, because it brings the Fed back into play much sooner than ever. Just a few weeks ago, everyone said no cuts because of the CPI report. CPI is seasonally strong in January and February. So that's a fake out. And now we get to see what's under the surface. And we also got to keep a strong eye on this GDP now at negative 2.4% for Q1. That's a big deal. Fortunately, the GDP now has been wrong of late, but 2 quarters is a recession, and I think that is low probability right now with 18% earnings growth, and I think the numbers of Atlanta Fed are probably wrong again. But you have to pay attention and keep keep your biases aside and deal with the facts. And so far, credit spreads are saying their numbers are probably wrong. U.S. initial jobless claims hit highest. Okay, D.C., we got that. Bond yields going down. We've been expecting that. That's happened. CapEx, we've covered. Pending holds. Inflows into Europe, everyone's chasing up. So maybe we'll have some problems with the European bonds, and that'll shake up their market, and we'll see some flows. We'll pay attention to that. Record outflow from crypto. So a lot of risk on stuff showing some fear. Here's Seth Golden with the AAII bull bear spread. You can see when it gets this extreme, a year out, 6 months out, on average, you're up 13%, a year later, you're up 22%. This is international stocks, second best month versus US stocks in the last 15 years. By the way, 15 years, every 10 to 15 years, it flips from US to international. It doesn't mean the US does bad. It just means international does better. What else we got here? Big rotation from Mag 7 to China BATX. We talked about this tremendous 10. These are going straight up. Those are coming down. They're going to meet in the middle, and then China's going to exceed it. Just like China dramatically outperformed, and then they caught up, and one caught up and one caught down. We're going to see Mag 7 catch down and Chinese stocks catch up, led by which? Ali effin Baba. Bull markets last longer than you think. We're only at 60. The average is 67 months. We are only at 28 months, so we're halfway there. Living on a prayer, and there we go. Europe stocks breaking out. This looks pretty healthy, even if you get a pullback. Probably a deal with Zelensky is what sets that up. Number of unsold completed homes for sale. Eye on the housing markets. You're seeing a lot of weakness in Florida. The houses inventory is super high. Prices being cut 10, 20%. That is often a precursor for other frothy areas around the country. So we'll keep an eye out on that, and I will have a front row seat in Orange County. We shall see as the marginal Chinese dollar stops flowing in because FOMO is happening in China with everything starting to go up. Maybe we will see some opportunities abound here as well. Big techs, big decline. We got that. This is another analog for the first year of the presidential cycle. Again, some weakness in late February through mid-March and then straight up into summer. So there's the dollar index just rolling over. What else do we have here? That's the Atlanta Fed GDP, keeping an eye on that. Eurozone loans to households. So credit expansion is starting to happen in Europe to businesses as well. PMI manufacturing back in expansion in China. Mag 7. So again, I think we're back down here. Probably get a technical bounce here. So for those of you who really like those stocks, probably get a little bit of bargain. For us, the margin of safety, even at these discounted levels, is not where we want to see it, but they definitely will probably work as a trade for many of you that like to do that stuff. It's not what we do. Let's see. S&P companies outperforming year on year. This type of acceleration of breadth is very healthy, and it's actually what we saw in 2001, when small caps, value, and international dramatically outperformed, even though there was some weakness, short-term weakness in the economy, and tech got smashed. Other periods where you saw this was the second term of Trump, where, again, a second term of Reagan, where, again, international outperformed domestic, as we saw the chart earlier. Friday's advancing volume, second highest since COVID 2020's market recovery. Interesting. I don't know why. Okay. Here we go. Dollar rolling over. Oh, this is interesting. The EU Aerospace and Defense Index up dramatically relative to the Mag 7 index. A lot of things are up relative. It's not hard to beat negative 7.7%. If you go to MAGS, which is the Mag 7 ETF, it's down 7.7%, maybe a little more by the close. 10-year yield down for 7 straight weeks. Remember, at 480, everyone was calling for 5, and I said 3 handle before 5 handle. And we may not see a 5 handle before Trump is out of office. So that's that. Goldman Sachs top-down S&P 500 forecast. We talk about guidance coming down. Home affordability is the lowest it's been since 2006, 7, 8. That doesn't mean we're going to have a housing crisis, but I do think we are going to have some normalization of prices, probably somewhat offset by lower mortgage rates creating demand. So it'll be a wash, and that affordability will go up as the cost of ownership goes down. You know, if you take a 10-year from 480 down to 350 and you get 30-year fixed rates at 5.5, the affordability from 7.2, which it was a month ago for a 30-year fix down to 5.5, you know, that's huge. That cuts 25-30% off the monthly payment. And even if prices come down 10%, I think you're going to see huge demand bids. So not a housing crisis, but an opportunity in the making, except where there's super froth. You know, there's some areas where houses doubled after COVID, then doubled again. Those I could see getting hit 30%, you know, but we'll see. Chop frustration is normal. We got that. Short-term sentiment, extremely pessimistic. That's just another indicator pointing to a technical bounce here in coming days and weeks. Put volume, second highest spike of all time. You know, so that tends to be a contrarian indicator. Large caps to small caps, S&P 500 divided by Russell 2000. Haven't seen it since 2001. I think you are going to see a rip your face off rally in small caps once we get through this tariff noise. And going into the close, I do think that Trump was saying that he likes the president of Mexico or something, and he's going to back off on certain things. You know, it's day to day. Welcome to Trump 2.0, same as Trump 1.0. Another day, another headline, another volatility, and it resolves to the upside. So just enjoy the show, ladies and gentlemen. Growth of. Okay, so that's that. Bull bear spread we covered. Crowded and cracking. It was momentum and it's getting smashed. I think Palantir was down another 10% or 8% today. Mag 7 earnings, reminder, decelerating. Unmagnificent 493 accelerating. That's why the opportunities are going to be in the unmagnificent 493. And coming out of the Mag 7, even if you get this technical bounce. So it'll be interesting to see when they get this bounce in the next few weeks, how many people chase up when they get back near the top of the recent range and then they get smacked again. But time will tell. 50% of stocks outperforming the S&P 500, up from just 30% last year. This is what we saw last 2001. What happened then? Regime change. International outperformed. Value outperformed growth. International outperformed domestic. Value outperformed growth. Small cap outperformed large cap. I continue to repeat this because it continues to not be believed, and even as it's happening right under everyone's noses in real time, and they're distracted with Trump when they should be paying attention to Japanese bond yields. Active investors have moved closer to the benchmark since 2023. All closet index huggers, complete valueless in that regard. And smart people know and have figured that out and allocate to people that are uncorrelated with the indices or low correlation because they're actually doing real work. 10-year treasury yield rolling over. Retail investors pile on Hong Kong listings through margin loans. Yeehaw, let it rip, ladies and gentlemen. Mainland buying BABA like it's going out of style, as we had anticipated last summer. And Brendan Ahern's done a good job of documenting that on his Twitter feed. Definitely check him out. US 10-year yield testing 2025 lows. No one here is surprised. Everyone else seems to be. European stocks rally to start 2025. Uncertainty at an all-time high. That's when you want to be a buyer, not a seller. And that's the GDP estimate's gone down to 2.4%. Tariffs. Okay, Ward's Automotive US auto sales SAR. Sales were down 2% in February, understandable with consumer confidence through the floor, with the fears around tariffs creating inflation, blah, blah, blah. Again, it's not whether the outcome is good or bad, it's whether Wall Street knows the rules. And once we have certainty in policy, market's going to go straight up on that type of 18.2% earnings growth. Guidance was weak. It's expected to be weak the first 2 weeks every 2 months every year, but not as bad as I thought. The estimates are still holding in at 271, down from peak 275, which is really not a big downgrade. And 2025-6 rather has gone up. So as always, back end loaded, set expectations low, exceed them. Everyone's happy until late summer when we get some seasonal weakness again. But in the meantime, the party will be on. Again, on no one's bingo cards right now, but wait and see, and that's what you will see. So crypto flows, the one thing that the crypto community may have overlooked is be careful what you wish for. That the thesis behind Bitcoin in particular, because some of the others have great utility. I've had great conversations with experts in Ethereum. I think that's going to be something to pay attention to as a real platform, but it's not what I do, so I'm not even going to comment on it. And I'm not even, it's like, I'm a golfer. I don't watch basketball that much. So I can enjoy basketball, but I have zero value add around basketball. So I'm completely agnostic about this. But as it relates to Bitcoin, because I see Saylor a lot on TV and everything, and leveraging it up like it's going out of style and borrowing money to buy more Bitcoin and all that stuff. And maybe it'll end well. And so far it's going well and everyone thinks he's a genius. But what they don't count on, if they get what they want, which is a crypto-friendly administration, putting regulation in, being pro-crypto, is that the very thing that put them in the position that they are is the perceived scarcity around Bitcoin. And what they may not be accounting for is the amount of assets allocated to crypto that only have, 3 or 4 legitimate places to go, whether Bitcoin, Ethereum, a couple others maybe. When the administration does what they want them to do, hundreds, if not thousands, of new crypto issuers are going to come to bear and compete for that fixed bucket of crypto assets. And you could say, well, the bucket will grow. Maybe it'll grow a bit. That's certainly possible. That wouldn't surprise me at all. But you are going to have thousands of new issuers getting into the gold rush. And while everyone thought the particular coin or token was scarce, what they didn't count on is an unlimited supply of coins and tokens that may be quote unquote scarce, but the overall bucket becomes unlimited and it dilutes the hell out of each individual one. And only the ones that actually have utility in terms of transaction ownership, etc., which is, 1 or 2, will get washed away. So that's where it is. I have nothing really valuable to say. Maybe, we won't, but something to keep in mind. Brent down. I keep looking for more opportunities in energy, and I keep pointing right back to Comstock Resources, which we have a big position side by side with Jerry Jones. None of the other stuff is coming out. Here's where we are in terms of tariffs. Again, we've covered this on TV. If he does 100% of everything, we're still nowhere near where we were we would be still below where we were in the mid-20s. Remember, they raised tariffs for some 12 straight years of economic prosperity before you got to Smoot-Hawley. So that's where we are. That's where we may be if everything happens. But already he's walking back Mexico, so that takes it back down. We are at record low historic tariffs, so just keep that in mind. Natural gas going straight through the roof. We like that. Okay, logistics managers. This is interesting. The logistics managers index, this relates to GXO, rose for a second consecutive month to 62.8, making the strongest growth in logistics sector since June 2022. Again, destock cycle to restock cycle, which we've covered many, many times on this podcast. Sharp increase in inventory levels. This led to higher inventory costs and warehousing prices, while warehousing capacity decreased because they had a glut of warehousing capacity. Remember, they built out too much because everything that happened at COVID peaked. Now it's being absorbed, and so on and so forth. So that should bode well for GXO in coming quarters once the CMA stuff is pretty much resolved and the new CEO is announced, which will be a rock star if past is any prologue as it relates to the type of people that Brad Jacobs attracts. Share of clients expecting the US to be the best performing global equity region at the Goldman Sachs Global Strategy Conference in January. The highest percentage of managers expected US to be the best this year, and they were all wrong. It's not even a competition. S&P down close to 1% year to date. Europe up 15%, K-Web up 25%, Bob up 65%. There you go. That's that. Chances of a cut we covered. U.S. trade policy uncertainty index. I mean, this is where opportunities are made. Everything that got hit by tariffs, I think, is going to be the buy opportunity of a century in coming weeks. And we'll just wait and see. Percentage of companies expected to outpace the Mag 7, up from just 8% at the lows of second half 2023, going straight up, and so on. And these are also coincidentally, the times you want that you start to see massive broadening. Alibaba shares held via southbound Stock Connect, absolutely ramping up. Every single mainland Chinese person is buying Alibaba stock like it's going out of style. Billions in, billions more to come. And the international people will slowly but surely start to be forced in, not because they want to invest in China, but because they want to keep their jobs. And the problem is they're so underweight China and they're so underweight international, and they're dramatically underperforming, and they now have job risk. So all of a sudden, their ideology about Xi and communism and all the bullshit excuses go out the window, just like you saw with all the woke is broke. Once they start going up, everyone chases them, and this time will be no different. Mortgage rates coming down. They're going to go a lot lower. China sets official deficit at decades high level. They're going to stimulate till the cows come home. Deficit spending like it's going out of style, 4% of GDP. That is a big deal, massive spending program focused on consumption. There's natural gas going through the roof. This was, don't have that date. Infrastructure. Daily trading sentiment has fallen to extreme pessimism from Ryan Dietrich, NDR research rather. This is where you get these technical bounces, so pay attention. That's bespoke, same thing. A lot of different indicators pointing to the same thing. That's the Fed. So last year's, we said the last will be first. That's been the case. International, healthcare, etc. The first shall be last. Palantir, NVIDIA, they're probably the so they were the best last year in the last 2 weeks. Palantir's down 32%. NVIDIA is down 16%. This is probably as of March 4th. And that's just the last 2 weeks. Year to date, it's double that probably on both of those. What else is getting smashed? Broadcom, Arista Networks, Marvel, Netflix, Tesla, and so on. Alibaba stock rose more than 70% since the January low. Euro rebounds to 4-month high against the US dollar is weakening. Euro is strengthening. Dollar is rolling over. Similar to Trump 1.0, we covered that. Look at this move in the euro. China switches priority to consumption in work report from high quality development. They did a complete 180-degree turnaround from last year, and look what's happening. Semiconductor cycle. That's the semiconductor cycle we covered last week. Small cap outperformer. This is interesting. This is the last time we saw these levels were early 2000s, and then again in 2009. And then we had a monster outperformance in small caps following those periods. So it's definitely worth paying attention to. There's the K-Web just getting started, cranking. Kudos to Brennan. We were in the foxhole together. I remember when we played golf together, someone, and I put a picture on Twitter, I think it was in the late summer or early fall or something like that. And it was near the lows. And someone said, Tom and Brendan getting together is going to mark the bottom in China. And they were right. It basically went straight up ever since then. So that's that. Here's another put volume. This is a washout. All these people that record put volume on the day I was on with Varney, those people are going to get flushed. The sellers of the puts are going to be the ones that made all the money. The buyers are going to get smoked. You know, just for future reference, ladies and gentlemen, you want to buy insurance on your house before you have a fire. It's amazing how many people buy puts in the hole when not only is the price near the bottom, but the implied volatility is at record highs, and people are buying puts in the hole as if that's going to protect them. It's too late, you know. You can't call Chubb after the house is half burning down. It's just one, the premiums would be too high, and two, they don't protect much because you only get half a house. So leave it at that. Want to put this guy on. He had some interesting things to say about daily domestic consumption.
David, final question for you. We've yet to talk about tariffs in this specific conversation, and the reason I frame it that way is I'm curious to what extent tariffs or the external challenges will be referenced these next few days.
Well, let me be very frank, okay? I strongly believe this time around, tariff is no longer a big issue. I would even, if you give me an order of 3 top issues in China or challenges in China, I don't even put top 3, even among the top 3, the tariff from President Trump. In fact, the whole economy was preparing for 40% or even 60% of tariff hike from President Trump. Now he's only imposing 10%. Of course, there are indirect tariff upon Chinese products from Mexico, from Canada, from Europe. But overall, it's still smaller than people anticipated. It's smaller than the year of 2018. So this time around, the Chinese economy is fully prepared. I do not think the tariff is a big issue. The way to deal with tariff is the same as deal with the other issues in Chinese economy, that is to boost domestic consumption. And on this issue, there's already tremendous discussions, and also a lot of policies will be implemented down the road.
And we're back. Alibaba stock is rising. Why it's bucking the tech sell-off? Obviously, this is the more optimistic writer, and he's done a good job over at Barron's Adam Clark. The other thing, oh, by the way, downloads of Alibaba's AI, okay, better than DeepSeek and OpenAI. Alibaba touts open source AI model that beats rivals. It's also the most downloaded. It just overtook DeepSeek in downloads. JD sales rise the most in years after China consumers awaken just the beginning, and Baba's going to get way more than JD is going to do, but that's just symptomatic of the whole group. They're all going to do well, except maybe Temu will do less well, and Pinduoduo. China steps up support for tech sector as AI enthusiasm soars. Chinese funds 35 billion bet on Hong Kong stocks fuels world's best rally. Downloads of Alibaba's AI model exceed DeepSeek. That is from Brendan Ahern. You should check his thing out at chinalastnight.com. Chinese buyers are ordering NVIDIA's newest AI chips defying U.S. curbs. Shocker. With Trump's tariffs paused, big three automakers may race to build inventories. So we may wind up with an enormous front load for Cooper Standard in perfect timing for them to have a blowout first and second quarter while rates are coming down to refinance the whole damn thing at low rates at the perfect time with amazing free cash flow, which is going to add more cash flow as they bring that interest expense down and volumes go up. So this may be an unintended consequence that no one is positioned for, thinking tariffs are going to crush advanced auto parts and crush Cooper Standard. And what's going to happen in reality is it's going to pull forward so much in the race and the open window as it gets delayed to produce as many cars as humanly possible. And they may pull forward a year's worth of production if there's any merit to this article, which I do think that there is. Dollar dinged by Trump tariffs. Disney stock rises. More staff cuts planned as it gears up for Netflix streaming battle. Weekly mortgage demand surges 20% higher after interest rates dropped to the lowest since last year. Trump says he wants this is the most important headline of the week. Trump says he wants interest on car loans tax deductible if U.S. made. If this goes through, our estimates on what Cooper Standard can do are probably 30 to 50% too conservative. Advanced Auto Parts revamps supply chain in effort to reverse sales slump. We included an interview with Shane O'Kelly in this week's article of the week. That Jeff found, and it's phenomenal. And everything he said he was going to do, he is doing. And people are, in the short term, voting machine based on emotions, long-term weighing machine based on fundamentals. I'm excited about this one. So we'll leave it at that. Here is an awesome headline as well. Exclusive NVIDIA and Broadcom testing chips on Intel manufacturing process, sources say. They're not doing this out of the kindness to strangers. They are doing this in their own self-interest. The reason we got bearish on NVIDIA in June and wrote the article on June 20th entitled The Next Pain Trade, which you can find at hedgefundtips.com. And while you're there, you should go to terms. This is opinion, not advice. Talk to your financial advisor. Don't do anything. Be conservative. Don't listen to anything I say. Terms and conditions there. The reason it's not because AI is not going to happen, and it's not because NVIDIA is a bad company. Both of those things are not true. AI is everything that you think great is going to happen in AI is going to happen. It'll probably take a little longer than you think, but it will happen, most likely. Number two, the problem with their decelerating growth rate is not declining demand. They have more demand than they can produce. It's they are not the captain of their own ship. They rely on the kindness of strangers. In Taiwan Semiconductors is only giving them $4 billion per quarter, and that's their limitation. As the base goes larger and they're still only growing at 4 billion, the growth rate is decelerating. Not because they don't have demand, because they don't have capacity. They rely on Taiwan Semiconductor. If Taiwan Semiconductor blew up tomorrow, NVIDIA would be out of business, okay? That's not going to happen, but they need Intel to be doing it. And the good news is Intel is going to do it, and it's going to be a money machine, and no one is prepared for that except for the folks listening here. I loved this article from Craig Bartlett, who is the former CEO and chair of Intel. He says, Intel is back. Stop talking about breaking it up. What he's saying was they should fire the board and rehire Gelsinger. And I actually agree with that. It's not going to happen, but they fired Gelsinger at the 5-yard line. You know, it takes years to build a fab, okay? And the idea of Taiwan Semiconductor investing $100 billion or whatever they're going to do to build fabs, good luck. We'll see you in 5 to 10 years. Intel is there. That's why NVIDIA and Broadcom are already testing the production in their 18A facility, which is showing really good results and will probably be live before the end of the year, and hockey stick, and no one's expecting. And that's going to be where the excess capacity, when Intel recovers, NVIDIA will catch a bid because there will be capacity for them to expand beyond that $4 billion a quarter, which is decelerating growth rate. So I think this board made a huge mistake. I think they will announce a good CEO. I think the foundry is going to work, and I think they should all be fired, even if they don't bring Gelsinger back. Stop the North Face windbreaker. All of our favorite celebrities are how to shop the North Face windbreaker that all of our favorite celebrities are coveting. So that's that in Elle magazine. That is the hell is her name? I don't know, but she's pretty popular. Anyway, so more great stuff from Bracken Darrell. Bessent says housing will unfreeze in weeks, sees 2% inflation. I don't know about the 2% inflation, but I do agree with what they're doing to the 10-year. Texas needs the equivalent of 30 reactors to meet data center power demand. AI fever in power stocks moves from nuclear to plain natural gas. Just beginning. Investors see 2017-like rally in the making for emerging market currencies. All the things we were pointing to that are now playing out. Humanoid robots finally get jobs. Where? Well, they get it at GXO Logistics, baby. That's that. Betting on the jockey stock market and sentiment results. This article goes into PayPal Investor Day with Alex Chris and Shane O'Kelly with Advance Auto Parts. We are running long on time, so we've got to get through this. And basically what we cover here is the turnaround plan. Look, at the end of the day, they're sitting on $1.8 billion of cash. They paid down their debt. They're closing the stores that they needed to close. They're consolidating the supply chains. Listen to this interview. We're not going to play this interview with Shane O'Kelly on the podcast because we simply don't have enough time. But if you own one share of this stock, you should listen to this interview. I mean, at the end of the day, nothing has changed from my original thesis, which is very simple. 7% operating margin, which they're still affirming, couple years out. Last time that implies $600 million of operating income, $630 million of operating income. And the last time they had that was 2019, 2022. There were 4 times that it hit that level of operating income. And in those years, the stock traded between $186 and $244. And here we have it at $35. You can't give it away with the balance sheet healthy, with competent management executing on the plan. And so, you know, no big deal. It's raining gold. We're pulling out the buckets. You do whatever you think makes sense. So go through this with fine-tooth comb if you own even one share of that. And then PayPal, opportunity of a lifetime here to take advantage. And there was an interview with a guy named Crossroads, and he's basically he's just like a college student or a PhD student. He doesn't manage any money, but he likes stocks. And he got an interview with Alex Chris, and it was a phenomenal interview. The full 30 minutes, you should listen to the full 30 minutes. This is huge. And
we can't talk too much about the stock price and price action, but it seems to me as an investor that there's a disconnect between what the market is seeing for PayPal, and it's reflected in the price action, versus the direction that you guys are clearly heading. And so what do you think is the biggest factor that the market may be overlooking in PayPal right now?
I have no idea. You know, I came here, I think the stock was significantly undervalued. We're up 20% year over year, and I think we're still dramatically undervalued. We inflected a business that had been losing money for 2 years in a row and delivered. If I'd come to you a year ago and said, how would you feel about 5% transaction margin, 6% transaction margin in 24? I think pretty much everyone would have been like, there's no possible way you can do that. And we delivered it. And then we put together, again, we're being prudent. I had a lot of conversations with investors when I got here, and a lot of the feedback was, hey, in the past, the company had been really bullish on projections and then missed. And that's just not my style. That's not the mentality that we have. And so we're going to tell you when we say something, we've got line of sight to it, and we're going to go execute against it. My guess is there's been a lot of suffering in this stock in the last few years. You just have to look at the chart and understand that, there was a peak and then it fell. And so we've got a lot of investors, both retail and institutional, that have lived through that. And I think with a brand new leadership team coming in, we're in a bit of a wait and see mode. And the best thing we can do is deliver for customers, execute our plan, provide you as much transparency as possible as to what we're doing, and have a very high say-do ratio. We beat every quarter that we told you what we were going to do.
Absolutely.
I know everyone wants us to beat by even more, and all of that happens. We also have to recognize that the innovations we're putting out take time, right? I've worked in different businesses. This just happens to be one where, we are at a scale where when we put a merchant innovation out, like these new innovations we have for branded checkout, they are crushing it. When you look at the conversion rate improvement, it just takes time to roll this out. We're talking about tens of millions of merchants, and even the largest enterprise ones, it just takes time to get into their ecosystem. We make a consumer change. We launch PayPal Everywhere. It takes time. I mean, the fact that we got 3 million new PayPal Everywhere debit card users in the first quarter and a half is insanely fast.
It is.
And it's still not good enough, right? Because everyone wants more. And so,
absolutely.
Look, I don't know how long it's going to take for folks to sort of say, hey, we understand that this leadership team is delivering on their commitments. But if you're looking for, everything to turn around in 2 months, this probably isn't the right stock for you. This is a business that we are building a flywheel that becomes the leader in commerce for the next decade and beyond. And that may take a few quarters or a couple of years. And I think we were, we put out some, I think, pretty exciting goals at Investor Day in terms of what we think our long-term transaction margin and EPS growth will look like. We wouldn't put those out if we didn't have line of sight to it. If we didn't know that, hey, when we execute on these growth levers, and we've got lots of growth levers now, when we execute on this, we're going to deliver it. So, again, apologies that this isn't a fast, flip of the switch and all of a sudden everything turns around. But 800 basis point improvement in transaction margin in the first, year is pretty significant. And I think we're just getting started.
Yeah, and the top line numbers, may not be what some people are expecting and hoping, but the bottom line, that's right. I feel like PayPal has been lacking.
Well, let's talk about that. Let's talk about that. So I got here and, we had really good revenue growth numbers, right? Really good revenue growth numbers. Empty calories, right?
Yep.
Revenue growth numbers with declining transaction margin. So look, it may be uncomfortable and it may be the hard decisions, but I'm going to make the right decisions for the company for the long term. Absolutely. And going back and having price to value conversations, I won't apologize for that. I mean, our revenue is absolutely slowing for a period of time until we have these conversations. But I can tell you, the conversations we're having are incredible. The conversations we're having with merchants now to be able to price to value, for them to be able to take all the different value-added services we're bringing together to now have conversations about ads. We are having healthy relationships that are building the foundation for growth for the future. So it is absolutely the right decision. And we've been as transparent as we can around, hey, revenue is going to come down for a couple of quarters and then we'll inflect and grow back. But I would much rather rip the Band-Aid off, have the hard decisions and build this company for the long term than grab a couple more quarters of increasing empty calorie revenue that's not delivering anything for the company for the long term, but it looks really good. And I just don't want to do that. I want to build this for the long term. So if you're interested in being with us for the long term, which I know you are, then I think this is the right place for you. And if you want a quarter of just big poppy headlines, it's probably not us.
Read all these points. The key point being, quote, I fundamentally believe guest checkout is going to be a winner take all market, and the guest checkout is the largest untapped opportunity. There's also some talk about the ad business became a monster business for Uber and a monster business for Amazon. And they brought over the guy who ran that to now run ads in the PayPal marketplace. That is going to go straight to the bottom line. There's so much stuff going on with checkout. I mean, it's interesting. I rarely buy up, but because, we were aggressive on this in the high 50s and so on. This, new money coming in over the transom from existing customers is going right into PayPal. Okay, that's what I can tell you right now. That I don't even have to think about. They're going to buy back 15% of the company in the next 2 years, even if none of this new stuff comes true, which everything he said is going to come true is coming true. And it's early days. So I just love what they're doing. And I think this thing is going to be a monster for us. So go through the details. I don't want to just go through the highlines, and then there's some stuff on Hormel. You can check out their cash flow. And once they announce the new CEO, this is going to recover, and it's going to recover very, very quickly because they've got legacy amazing brands that are right in the sweet spot. Here's Extreme Fear on the fear and greed. This is where you want to be a buyer, not a seller. Earnings, top 30 weights of biotech down a bit for this year and next, but it's already reflected in the price at this point. Same with equal weight. And insider buys in FMC. We've been talking about a lot of the ag stocks and insider buying in Advanced Auto Parts this week. So, and that's from like a low-level employee, HR officer went into her pocketbook and picked up, $35,000 of stock. It's a rounding error, but for someone who is not an investor, that's just an employee to pull out their checkbook, that's not nothing. We talked about the earnings growth. Okay, podcast is over. Now we're going to do the Ask Me Anything questions for everyone who likes that part of our weekly show. We're excited to cover that here. So let's kick it off with Josh Jacobson. Thank you for the great work you do every week. Your consistency is unmatched. I want to get your opinion on Arista Networks. Okay, so he said valuation still looks a little rich. Does it make sense to get into a great business even if the valuation is a little rich? No. Why would you get into where the valuation is rich? It's not the only stock in the market, but let's see if that analysis is accurate. I'm probably 90% chance I'm going to agree with you on that. Just pass. Wait till it comes to you. And if it doesn't, forget FOMO. Or if it takes off without you, so what? This definitely looks like it's ready to bounce on a technical basis, along with the Mag 7 and many others. So if you're a trader, then, have at it. If you're an investor, let's see what we're looking at here. Here we go. Okay, I forgot to turn this back, set as default. We like to zoom out here at Hedge Fund Tips with Tom Hayes and not get caught up in the daily noise. No way. I'll just save you time. This is a stock that's up, 30x in a handful of years. It's got to rest. This looks like a broken momentum stock. And where you're going to get faked out is the fundamentals are going to come back down quicker. Well, I mean, this is kind of fascinating. I wouldn't be a buyer here. I just wait for a while, and if you miss it, you miss it. And I think you already know that. So kudos to you from being a loyal listener, not chasing shiny objects at the top. and let other people be the bag holders on that. JT Investor, could you shed some light on what caused VFC to drop this week? The market's going down. People are over leveraged and they're getting smoked, and nothing's changed in the fundamental plan and execution of Brack and Darrell. And by the way, if we zoom out, I'll bet you can't even see it. Let's see. VF Corp. Yeah, so it's gone straight up for like 3 straight months. It's going to correct and consolidate. That's what they do. That's what they do every single cycle. Straight up, correct, consolidate, huge run. Straight up, correct, consolidate. For here, it was a year, and then straight up. So relax. Next, Patrick B. What's your take on the IT consulting service space? I've never liked it. GFT Technologies. And the reason I've never liked it is because your assets go down the elevator every day. So let's see. GFT Technologies. I don't like these businesses, so I'm going to just pass. Mark Calloway says, hey, Tom, and thank you for all that you do. Not lip service. Truly, thank you. I know you say it's a great time to pick individual stocks, but do you have a preferred ETF to put my adult kids in that are brand new to investing? So many I've looked at are heavy on the Mag 7. I would do a combination, do some US. VTI is less concentrated in the Mag 7, and then VXUS, XUS. It's a good place to start with those two if you just want to passive for the long term. Maybe some emerging markets and maybe some small cap. So IWM would be small cap. Emerging markets would be VWO or EEM. And that's opinion, not advice. But great question. Thanks for listening. Ivor Barry, thoughts on Porsche? We do not buy car makers. We buy part suppliers. Daniel Borkman, what is your thought on Ray Dalio's warning that a U.S. debt crisis could trigger a heart attack in the next 3 years? Let's see. Ray Dalio crash. Okay. So he said 3 days ago we're going to crash. He said let's see, market crash. Basically every 2 years. Look, anyway, the point is the guy made a lot of money, and he's effectively a bond/commodity guy by training, and these guys are always negative. And the beauty of that is they get a ton of money because there is more AUM in debt instruments than there is in equities, as the debt markets are much bigger than the credit markets. And the way that you get people to invest in credit is by scaring the shit out of them. And then they give you all their money in credit because they don't want to take equity risk. And that's that. So look, if you Google, you will see every 2 years, he says the market's going to crash. And the fact of the matter is, he was right in 2008, and he made a ton of money. And you really only have to be right once or twice in life to make a fortune, whether that's in buying businesses, building businesses, picking a wife. You don't have to be right a million times, and nor should anyone expect people to be right. I mean, at the end of the day, the guy made $14 billion. So what if he made a few bad calls? He made 1 or 2 right ones, and he made a fortune. So I wouldn't worry about that. He's going to be right again at some point. I don't know if it's in 3 years or 3 months or 20 years, but the message has been consistent. Let's just leave it at that. Luca Milo, thanks for the amazing content every week. I share it with everyone that's interested in financial markets, and they started following you too. Thank you very much. What do you think of Legged Platt? It's a furniture maker, so it's going to be, in the short term, going to be hurt. I think that it did have some balance sheet risk, but it's in a big downtrend. I mean, the number one thing you need to do on this company is solvency risk. But I think this could wind up being an interesting, if not trade, investment. But this is the type of thing where I'd probably have to go understand the business really, really carefully before. So it looks like they've got $350 million of cash, and how much debt? $2 billion, or $1.8 billion. So you got to see when all that comes due. You got to see what they're generating in terms of. This is the issue. Let's see here. Cash from operations. Now, cash from operations is not bad. $305 million. Free cash flow, $224 million. So you just have to do the math on. Let's see, cash from financing. Cash interest paid, $84 million. You just have to see when all of these come due. But I like the idea. I definitely like the idea, Luca, and it's probably worth some more work. Okay, we got that. This one is from Grayson Harris. What sort of path in the finance industry would you recommend college students who enjoy value investing? What sort of firm environment would your college grad be able to prosper in as a solid value investor without going off on their own? Number one, you can try to go off on your own, but I'm going to repeat it. I would never suggest taking other people's money to manage until you have proven that you don't need any money because you've made enough money in markets for yourself. And you've gone through 2 or 3 cycles working for someone else, and proven that you have lived through enough cycles and you know what you're doing before you take on that enormous responsibility. Because if you do it wrong and you do it early, you will not recover. I don't even say that remotely lightly. That's serious as a heart attack with that advice. And then what skills do you hone through value investing that are transferable to other sectors? I think it's the language of numbers is critical for any and all businesses. As a matter of fact, I think it's critical if you're in school and you can take accounting courses and you can take finance courses. I would say that your odds of success in being an entrepreneur and starting a business are much higher than your odds of success as an investor. And the people who do investing well make it look a lot easier than it is, because for every word that comes out of their mouth, there's probably 75 thoughts and historical frameworks that are running in the background that you don't know and can't understand without living through 20 plus years of markets. So that's number one. Number two, it's a lot more competitive than you think. You're going against the smartest, smartest students in the world, smartest, people got the highest grades and all of that stuff. So it's not a walk in the park. I mean, if you absolutely love it and it's what you do, if you wound up at another job and like all night long, all you're doing is studying stocks and you don't go to bed till you get to your job and like it's what you love, then it's probably what you should do. But if it's like, oh, that's where I should go to make money because I can make more money, huge life mistake. You won't be able to compete with people who love to do it 24/7, and you'll get smoked out. So my best suggestion in your 20s is you don't have to be a genius. You just have to be persistent and consistent, and you could build a business that'll make you so much more money before you're 30 than you would ever make in the finance industry. But if you play the turtle hair game, having the skill of being a great investor, when all is said and done, by the time you're 50, the scales tip and you got compounding in the rearview mirror and you might wind up a lot further ahead. But you really have to love it. I would go to youtube.com under the Hedge Fund Tips channel and put in the search bar University of Bristol. I did an hour interview with their investor club on my suggestions if you do want to get into the business. It's a narrower opening than it was 20 years ago when regulations were easy and anyone and their mother could start a hedge fund in the early 2000s, and that all changed when the rules changed. So it's a lot more expensive, much higher barriers of entry, a lot fewer startups, but also I like that because it creates a moat, so or a small moat if you're really good at it and you love it. So the short answer to your question is, if you love it, go for it. You'll figure it out. If you are just doing it because it looks like an easy way to make money, absolutely do not go in this direction. Go build a business or go work for someone first. I think there's so many unbelievable opportunities to make a ton of money as an entrepreneur nowadays with all the platforms available to you and all the ways to reach markets that have never existed. If you have a good idea, go for it. And you may fail in 2 or 3 businesses in your 20s. That's perfectly normal as an entrepreneur. In finance, you can't do that. You can't blow up a fund and expect to ever come back. I mean, people do it, but it's the exception, not the rule. So that's in a business, you can just rebound and do it again and do it again. Most entrepreneurs probably fail 2 or 3 times before they have their big hit. That would probably be an exciting way to live if you don't know if you love investing. But that's that. Michael Silber, Tidewater. I just go with Schlumberger if you have to, or yeah. This was obviously dilution at some point. I don't like that one. Even Rig I don't like. I would just go up the food chain and go to something like SLB or HP or NOV if you have to be in the space and you can't resist. That's probably more where I would be interested. But I don't have to, so I won't. Moving on. Christopher Williams. Block, not interested. We like PayPal. No. David Martin. Philippe. Do you have a preference between Bungie or ADM? I would go for Archer Daniels Midland. RCI. What is this thing? Is this a cable operator? Yeah, communications company, wireless, cable, and media, internet access. I mean, this is kind of like the Comcast story. They all look interesting here. I think this will probably wind up working, but I would definitely do some work on it here. But if you're totally right, you're going to get a double. And I don't think it's a good enough business to take that risk. And I don't need to be totally right. I like things that I can be half wrong and still make a triple in a few years. So that's not for me. Kyle Burns. If you were the CEO of Advanced Auto Parts, would you be doing something different than Shane O'Kelly, or do you feel that he's doing the exact same way you would do things, or is there room for improvement? I literally wouldn't change one thing that Shane O'Kelly is doing. As a matter of fact, he's doing a better job than I would, and that's why he's going to wind up with probably a triple, if not more. And that's why I just picked the jockeys versus having to implement the execution, because I pick people who can do it better. It's the same way. It's the same reason that people who are, centimillionaires and billionaires pick me to manage their money. It's not because they couldn't learn it and do it. It's because they're already rich. So they're going to delegate to someone who's specialized, that they don't do it all day for 20 years. And just like I'm going to delegate to Shane O'Kelly, who's been doing this stuff for 3 decades between Home Depot Supply and other successful runs. And you can hear his whole interview. And Bracken Darrell, from Old Spice days to Logitech to Procter & Gamble. I mean, these guys, that's all they've done for decades. So I'm going to delegate the execution to them because they're going to be the best at it. It's not because, Shane O'Kelly is 10 IQ points higher than Tom Hayes, therefore he's doing a better job. It's because that's all he does. And so on and so forth. So the more successful people you meet, the more you will realize that they delegate more than you would ever imagine doing. The things that you could do are different than the things you should do. The good is the enemy of the better is the enemy of the best. If you are not doing your highest and best value, and you're not delegating, you're doing a disservice to the world. So I'm at a stage now where I'm delegating everything that's not picking stocks or interacting with clients, the things that I do best. Everything else has been effectively delegated now, more or less. I'd say if I'm not 80% there, I'm 80, 90% there. And all I have to think about nowadays is picking stocks, which is what I love to do, which is my highest and best use. Because you don't outperform by consensus. Any of the best funds in the world, it's 1 or 2 people, and usually one person making all the decisions. And then they have support staff to get everything else done, and operations and excellence and all of that stuff. And by the way, that was the case for Dalio, by the way. And I know his number 2 extremely well, played poker with him for 10 years. And they made effectively all the decisions. Even though they had 1,000 people, they had 1,000 bodies. Why? Because when pensions come in to see you, they have this metric, and the more bodies you have in seats doing busy work, the bigger the check they're allowed to write you. So if you want, $200 million from a pension fund, you better have 50 people sitting in seats. Whether they're doing anything or not is immaterial. It just pays to pay them a salary to sit there so you can get a bigger check from a pension. I'm not in that game. I've never optimized for maximum AUM. I've always optimized for quality of life, doing what I love, and making sure that every single partner I have, every investor, is someone that I enjoy, respect, and would hang out with whether or not we did business. And if I meet that, I live a happy life, they live a happy life, everything's good. And if I optimize for AUM and I start dealing with 12-year-olds with clipboards, counting the number of bodies in seats, it takes me away from doing what I do best, which is picking stocks. So that's how I've decided to live my life, and it works great for me. Okay, so David, okay. Thoughts on Docu or Valet? DocuSign. I don't really have an interest in this. I don't. All right, let's try Valet. Valet will probably work for a trade, but I mean, you're lucky to make a double if everything goes right. So for me, no, but I think Valet is ready to go. Nick, thank you for all your wisdom and help with things in the stock market. I'm an avid listener every week over here in the UK. I want to ask your thought about Powell Industries. Okay, POWL. Thank you, by the way, for all of the avid listeners, and particularly those folks. No, this was a 20 bagger. It's a broken momentum stock. I don't want to buy it up here, regardless of how good the fundamentals look now, because the stock is telling me that the fundamentals are probably going to deteriorate pretty quickly. So for me, that's a pass. David Gavin, look at Denny's. These are tough. I mean, we're over restauranted here in the US. All this is a debt story. Let's take a look at the balance sheet here, because question is whether this thing, why is the cash so low? These numbers have to be wrong. If these numbers are right, run for the hills. I think these numbers are wrong. It says they got $3 million of cash and $261 million of debt. I don't know that can be right. Let's see what their free cash flow is. This is not for me. I mean, it looks like it wants to bounce from a trading perspective for sure, and it is a legacy brand, but that's just going to go in my too hard box. Alex, CK Hutchison Holdings, Hong Kong. I will not buy any Chinese stock other than Alibaba, and if I had to buy one or two more, it would be Baidu and Tencent. I won't buy any mid caps or small caps. I'm not taking country and company risk. I mean, our original thesis with Baba was if Baba goes down, so does China. I mean, that's basically what it comes down to. So I've seen too many frauds in China over the years. I've seen people get burned by frauds in China every cycle. No way. I mean, Alibaba has been stress tested over and over. There are tons of outs. I'm not going to play in other stocks. So, if you want a laggard in China because everything else has moved up, if I had to put a ton of new money to work in China and I didn't want to chase up Baba, I'd probably start to take a hard look at Baidu, and that'll be a lower quality but catch up. But as far as betting on like obscure stocks that I have no edge, hard pass, because we're going to pull up the numbers. They're going to look great. And then there's a coin flip chance in 9 months it turns out to be a fraud, and there's nothing like you can do about it. You have no edge. James sent me a nice article in the FT. You can probably check out. It says investors should be wary of analyst ratings. And I make the joke of how Morgan Stanley downgraded China and Alibaba at $70, and now they're upgrading it at $140. So this article kind of embodies that. And it's not just Morgan Stanley, and it's not just China. It happens over and over and over. When the stock is down, they all downgrade in the hole. When the stock is up, they all upgrade at the top. And that's the name of the game. So analysts are now flipping on Baba because the price has doubled up plus. But it's just the beginning. They will start to come in herds, and after it gets over 200, everyone will be upgrading. And when it's beyond that, you will see everyone uniformly bullish in the 200s with price targets over 300, and that's when you have to start to look carefully at fundamentals. But we're nowhere near that point. 4 years. This is from Matt in North Carolina. 4 years of listening to the best content available on the internet. Never missed. Thank you. Thank you. I appreciate your loyal support. Trump suggests get rid of the CHIPS Act during his speech. Taiwan Semiconductors is going to build foundries in the US. I mean, good luck. And Boeing is going to build planes for Southwest. Get in line for 25 years. I mean, if Taiwan Semiconductor starts today, they're going to have to go through tens of billions like Intel already did, 4 to 6 years before they even have a chance. And by then, the AI revolution is long in the tooth. So Intel's going to be the beneficiary, whether they partner with Taiwan Semiconductor to have Taiwan Semiconductor operate. I wouldn't bet on it. And I would fire the board and I would bring Gelsinger back. But more likely than not, they will bring some big name in and they'll get the job done. And Gelsinger will get no credit, even though he did 90% of the work. And the new face will get all the credit and go to the promised land. So sometimes in life, better to be lucky than to be good. That will be the next CEO of Intel. Griffin Brown. Cooper Standard. You mentioned Paris. Companies like Cooper Standard will not move plants to the U.S. to save money. Recently, I've been seeing many headlines about companies, mainly vehicle, moving plants to the U.S. due to tariffs. What are your thoughts? This has been happening for years. Some Toyota builds cars in Tennessee. I mean, the OEMs will probably do it. Will the part suppliers? I mean, a lot of this is also going to be symbolic to appease the administration and make the administration look like they're doing the things that they said they're going to do. But to invest material amounts of money for 3.5 years, and by the time the factory's done, there's a new administration in, and your competitors are going to be going offshore for cheaper labor. You will see. It's a cost-benefit analysis, okay? So if they think that they're going to save money on tariffs by building a few factories in the U.S., they will do that. But they also, it's time value of money, and you're talking about a 3.5-year window. So it's going to be, the headlines are going to be more than you think. The reality is going to be less than you think. And at the end of the day, you still have the average car on the road 13.5 years. You still have the bulk of the population at 34 when they all move out to the suburbs, have a kid, and buy a second car. That's not going to change if the price of a piece of rubber goes from $190 a car to $210 a car, and your MSRP goes from $50,000 to $50,000 in 20 because the rubber got more expensive. It really is immaterial. If you're selling transmissions, maybe that's a different story. If your part goes from 7,000 to 8,500, you might have a problem. But if it goes from 190 to 210, it's like it's a rounding error, and it's going to be passed through to the OEMs and then through the customers. But also, if interest rates go down and then you have tax deductibility on the auto loan, that's a big deal. That's a big deal. Bill McGrew, thanks for doing such a great podcast. I never miss it. Wondering what your thought of APA. A little cheaper than Comstock on a enterprise value to free cash flow. That is not a metric you would use for an energy company. You're looking at proved and unproved reserves value. I think Apache's okay, and I think that Comstock has more upside on a multiple basis. So we're already at 2.5 on 2.5x on Comstock Resources. I wouldn't bet on Apache even being a double. And I think Comstock is going to probably double again from here. So that'll be like 4 or 5x, and will not be the case with Apache. If you're lucky with Apache, it'll be up 50%. So I would just leave it at that. That's not the way you value this type of company. But longtime listener, can you look at Halliburton? Yeah, I like Halliburton better than I like Tidewater. Let's just put that in here. But I think I think you're taking some kind of risk for a maximum double. It's not terribly exciting for me, but yeah, if you want energy exposure, it's probably okay. Okay, Statman emailed in from La Quinta, the wonderful high school that I had the pleasure to speak with a few weeks back. Nope, that's not his. Let's see. What note did he say? Nope, that's the old stuff. Okay. Well, what he was saying was that his students were having a great time listening to it, and I'm very grateful that they've stuck with it, and I hope it makes a difference for a handful of them that go on to have incredible careers and do great things. Bill C. Thanks for all you do to help us retail investors. I know you were bullish on healthcare. Your thesis has already played out in the large cap healthcare space. XBI, yes, we like XBI. We own XBI. Small cap value ETFs, absolutely. You're spot on there. Paul Rosenberg is asking about that gaming company in Europe again, EVO. I don't like those businesses because they are very cyclical. This is broken. It's going to take a year or two to base. So, if it's between $2 and $4 in a year, send it back in and we'll probably buy it, or at least say yes, buy it. But I think it's too early. Chinese stock, GDS, no interest. Terry Smith, love your podcast. Booz Allen Hamilton, no, don't like it. I don't like the consulting businesses. When they run, they're unbelievable, but not for me. I'm gonna pass. Let's see here. We have a lot of questions this week, which is great. Jimmy Jones. When do you suspect Ant Group IPO? Probably in the next year would be my best guess, if not sooner. We own 35% of it, so it probably adds initially 20, 30 billion, and then over time, probably $100 billion worth of value that's not in the stock. David McLean. Greg's, Greggs. That's interesting. I think it's a fast food chain. So cash flow has been deteriorating for 2 straight years while revenue's been going up, margins are going down. So just tell me how they're going to turn this around. Why are margins down? How much is the stock down? About 40%. What's the balance sheet look like? $500 million of leases. What's cash flow look like? What's the share count doing? Looks like they're expanding. They're probably investing in a lot of new stores is my guess. Where's the share count? Yeah, I mean, this thing looks, at first blush, it's definitely worth more work. I think you're probably okay here or near here. At 1,500, I'd be probably a lot more interested, 1,600. But I think if you're long-term, you're probably going to be okay. But I don't know the business, so you got to really understand the business. Like, is there something wrong with the business? Has it fallen out of fashion? Or is it just a normal cyclical trough? What is it, Greg's? Food on the go retailer in the United Kingdom. Let's see what they sell. Okay, accept all cookies. Greg's. Nation's favorite sausage roll. Oh, it's like a fast casual. Yeah, I mean, the numbers look okay. I don't really have an edge here, but it generally passes the smell test and would be warranted to do a lot more work before making a material position. But it's if you're 100% right, you have probably a maximum of a double, and it's going to take you a few years, which is okay. Hi, Tom. I'm following. This is from Pete Basterts. Following your show for 2 years and really like your style and expertise. In my quest to educate myself in the investing space, your podcast is much watched weekly. And by the way, you're the #1 reference I share with friends and family because of the unique macro and micro combo. Could you take a look at Umicore, European materials stock? Just wrote off the battery recycling. Okay. Yeah, the question is whether they fired the CEO who made that decision. That's the key. If it's the same idiot running it, that's not ideal. To make an enormous bet on battery recycling just tells me that there's a screw missing in his head. So, Umicore. Yeah, I mean, this is down a lot. My guess is the balance sheet's going to be looking shaky here. No, $2 billion of cash, $2.4 billion of debt. What's going on with free cash flow? Cash from investing. Yeah, balance sheet. It's good. Income statement. This is a pretty big drop off. Revenues have cut in half. All right, so they made a bet. Precious metals, business minting cash. And also various other units. God, I just want to know, how are these revenues going to stabilize? Balance sheet looks okay, but you got to look and see, when does all that debt mature? This thing is a falling knife, but you could have an opportunity there. I would really love to see this CEO fired who made an all-in bet on battery recycling. Oh, excuse me, former CEO. I think you might have something. I think this is worth looking into. Good work. So I'm going to write that one down. Umicore. All right, good work. And I think well, sorry, Statman, I don't have, let's see, because he sent it to my Great Hill Capital email, and you got it. When you're trying to get something on the Ask Me Anything, guys, please send it to, go to hedgefundtips.com and click on contact. Do not, okay. All right. So here's what Cork says. My kids are having more fun and the conversations are better than ever with their stock market game. Fictitious 10K to start the game ever since you came to La Quinta High School. Alibaba is a daily conversation, and the kids are generally asking better and more insightful questions than they had in the past. Stats is always a lively subject anyway. But you have added to the circus that my classes are in a fun way. Keep up the great work. All right, Cork, well, you keep up the great work. Hello to all the students at La Quinta High School out here in Orange County, and very, very glad to hear that made a difference. All right, so let's see if we have one more Ask Me Anything question, and then we'll call it a day. Akamai, AKAM. This is from Oz Smaja. Yeah, I mean, I think this is going to be one of those where you got to be 100% right to make a 50% return. And I just think that I like this. I just go for softballs down the middle where I can be half wrong and still make a triple. These type of things, you're getting in front of steamrollers for pennies. I think you're going to be fine with this, but it's not something that I would take. Great free cash flow. It's okay. I mean, it's not a great business. Let me see the balance sheet real quick. Looks okay. $2 billion income statement. Yeah, it's okay. It's not something I would do though. I need doubles and triples to get interested. I don't think you're going to get it with Akamai. Dan Flicker. Tom, thank you so much for the value that you provide. I'll continue to spread the word about the incredible podcast. Thank you, Daniel. That's the number one way to pay back. Wondering what your framework is with broken momentum stocks. Take Celsius, for example. What are you looking for in a bottom process? I could care less about price multiples at that point. I want to see the balance sheet, cash flow statement. They just tend to take a while because they, so many institutions and retail traders. Celsius. Got smoked, so it's going to take a long time to rebuild a shareholder base. This one is interesting though. So I think it just got to be super patient. I think this one might be actually okay here. We've looked at it a number of times. I hate to even take the time to do it. I think this one's generally going to be okay. But you have to do a lot of work. You got to understand why. First off, you need to understand the short story. Why is it down so much? And what's the story? Is it the stuff in it makes you sick, or is it something else? And what are they doing to resolve and alleviate that? What's happening with volumes, and why did they have to buy acquisitions to reignite growth versus continue to grow organically? Did they stall? But I think the balance sheet is probably okay here. Liabilities, long-term debt looks good. Let's take a look at income statement. 1.3 billion. So they're kind of stalling. I mean, this is the problem. They were doubling every year and then they stalled out. And sometimes they stall out before they decline. Sometimes they stall out before they reaccelerate. So you got to be clear on the international story. Why are they stalling? Is the market limited, or was it a fad, Or is it durable like Monster Beverage was, one of the greatest stocks of all time, Hansen? And what are we doing with the share count here? They're adding a lot of shares, man. I don't like that. This one's definitely worth doing more work on, because I do think you can get a double or triple if you're right. So I'll write that one down again. It's very hard to have an edge because you're kind of predicting the future of consumer fads, because it's not been around long enough, and it's a very crowded space, unlike when Monster Beverage came to market, unlike when Red Bull came to market. That doesn't mean it can't be done, just it's not a guarantee. Okay. And I think we have nailed it, and we've done all of the questions. So with that said, very, very grateful to all of you who have been tuning in, getting in tremendous value. All I ask is to like, subscribe, and share to the YouTube channel, and that'll keep the machine going, and we'll be able to do this for many years to come. Thank any of my clients when you see them wearing green Vans around. They all got green Vans for Christmas, so definitely thank them for indirectly underwriting, and grateful all around. So thank you. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.